domestic supply and demand. Shares of Universal Music Group also plunging in the Amsterdam trade, down 25%, the biggest drop since their IPO. The world's biggest record label, which represents Taylor Swift and Drake, reported subscription and streaming revenue that fell short of analyst estimates. It was a slowdown in streaming platforms and adding new subscribers that ultimately hit revenue. Meanwhile, a dispute with TikTok and licensing changes for Meta also hurt them in the quarter. The NBA has announced new long-term contracts for TV with Walt Disney, Comcast, and Amazon, spurring long-standing partner Warner Brothers. The league rejected Warner's bid to match Amazon's offer of about $1.8 billion a year, setting up a potential legal battle. The new agreements are set to generate $76 billion in fees over the next 11 years. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. We're going to look to, accelerate that progress.
That's the view from Ford, the view from Stellantis. Up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
I do love Elisa promo. Just some of the best. Look out for the Federal Reserve.
Haywire.
Sort of a long list of things there, Lisa.
I need to really kind of sit back.
Don't sit back. We love it. Equity futures on the S&P pulling back just 0.1%. Under surveillance this morning, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. The team's focused on it. There will be additional cost reductions. We're on track to take $2 billion in material cost out, manufacturing costs, freight costs, and we're going to look to, accelerate that progress.
Here's the latest this morning. Auto earnings reflecting some big challenges for the industry, with Ford and Stellantis delivering disappointing results. Stellantis opting to bring back old models and weighing price cuts after a massive drop in sales during the first half of the year. Joining us now to discuss, the Stellantis CEO, Carlos Tavares. Carlos, great to catch up with you, sir. Difficult morning for the stock. We're down about 8%. You know that. I want to talk about some of the brands. I'm not sure how many people recognize or realize how big this company is. So just give me a couple of seconds to go through this. At the premium end, you've got the luxury brand like Maserati. Then you've got Alfa Romeo, Lancia. You've got Jeep, which of course is well known here in the United States. Chrysler, Dodge, Ram. Over in Europe, Citroën, Fiat, Opel, Peugeot, Abarth, which of course Abarth is part of the Fiat business. This goes on and on and on. And I'm trying to work out this morning, Carlos, whether you're committed to all of that lineup, those brands, or whether some of them could be cut and spun off.
Well, there is, first of all, you are right to say that the automakers are under pressure. The auto industry is in a turmoil, and as you are looking at the results, everybody is going in the same direction. And for the time being, as much as I am aware of, we are the only guy in town with a double-digit AOI margin. But you are right, we are under pressure. And to your question about the brands, there is no taboo. There is absolutely no taboo. The brands are intangible assets that we respect. We believe that they are here to be leveraged. We could celebrate this year the 125th anniversary of Fiat and Opel, which demonstrates that the brands are stronger than the legal entities, stronger than the political regimes, and they can cross wars, survive, and get better. So we do respect the brands. We respect the fan bases of the brands, but there is no taboo. If they are not able to monetize the value that they represent, then decisions will come. For the time being, all of our brands, with no exception, are profitable. It is not by chance that we are a 10% AOI margin car company, the only one to be double digits so far. It is just because our brands are great. Our products are very appealing, and I will just use the example of our Ram pickup trucks, where we were again #1 in the GD Power quality survey, which means that our customers appreciate what our creative people are bringing to the market. Now, it is true that the market is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil. And the most resilient, the most focused, the most customer-focused will survive, of course. And that also means, because that's what I'm hearing, that cost reduction is not becoming a taboo anymore. As you know, we have been working hard on cost reduction for many years. We have not been so popular, but now everybody recognizes that the customers want affordability. The customers want a safe, clean, and affordable mobility. So that's my comment to your great question. Thank you.
There's one question about cutting the cost of the vehicle. There's another question about cutting costs internally to offset some of the increased expenses. Shipments in North America fell 18% in the last quarter, and I'm just wondering whether some deeper cost cutting, to John's point, is required to sort of bring that up to speed at a time where the EV transition isn't happening as quickly as people had planned for.
Exactly. And what you are saying, you say is not happening as quickly as the people had planned for. I would like, with all the respect, to correct that. It is not happening as quickly as the political leadership had expected. What we are seeing in the Western world right now is that the consumers are not supporting as much as the political leadership was expecting the EV ramp up. And the consumers, they are very clear in what they expect from us. They expect safe, clean, and affordable mobility. And safe and clean they are, affordable is the challenge. So they want basically to buy EV cars at the price of internal combustion engine cars. They don't want to pay more for the EV technology, which I can totally understand. And I want to tell them that we are working super hard to achieve that. And we already have evidence that we are succeeding, because we started to launch our first B segment EV cars from 20,000 euros, a little bit more than $20,000, and we will bring to the US market in a couple of years a Jeep model below $25,000. So yes, we hear what they say, and we are working super hard to deliver that. And indeed, the political leadership through the regulations thought that the consumers were able and willing to pay a higher price for EVs. And they are telling us, the consumers, that they don't agree with that. And we are in the middle. We are the fuse between the consumers and the regulators. We are trying to fix it. And of course, it's difficult. It's difficult.
Carlos,
it's painful.
in January, you said you were going to hold off on some of your investment in the United States because you wanted to see how the election played out. But are you basically saying now it doesn't matter who gets elected because the consumers are rejecting the government push towards the EV models?
Well, that's not exactly what I am saying. It's a little bit more complicated than that. What I'm saying is that we have received loud and clear the message of affordability that the consumer is asking us to deliver on EVs. The sooner we get there, the faster we are going to ramp up. And the investments in EV technology are already done. What needs to be done now is the investments in the capacity for the volumes. So the investments in the capacity will be staged in function of the adoption by the consumers, and the adoption by the consumers is going to be a function of our ability to bring affordable vehicles to the market, which we are right now doing. And I think it's going to have a few bumps on the road. That's nothing specific or nothing surprising. It is going to be a bumpy road, and we will adapt the capacity investments to the adoption rate of the consumers, which is going to be the consequence of affordability. That's where we are.
Yeah.
And we are bringing a lot of proof points that we are achieving that, starting with the European market right now, but it will come very soon with the US.
Carlos, how difficult is it to compete right now with Chinese auto manufacturers who really have a leg up in providing affordable electric vehicles and are able to export some of those to Europe? Right now, there are gates in the US. Are those gates positive or negative for you at a time when you're a global car business?
Well, that's a great question. As we are a global car maker, and it was pointed out that we had a 14 plus one brand. The plus one is a Chinese brand, Leapmotor. So yes, we have 15 brands, and we are a global car maker. So as a racing team we need to recognize that being global means that we will not be protected everywhere. For instance, we are not protected in Latin America. We are not protected in Africa, Middle East. So as a racing team we need to confront ourselves with the harshest competition. Right now, the harshest competition is China, and they have a 30% cost competitive edge against us, ex-workspaces. And we are working hard to recover those 30% cost competitive handicap that we have. And it's good for a company like ours to be competing with the harshest competition. That keeps us awake, that keeps us alive, and we need to run fast and even faster to compete. Then when we come to protected markets, we have to realize that there are a lot of side effects and collateral damages to protected markets. And that protection that may be nice in the short term may have enormous disadvantages in the mid and long term. And that's why we do not advocate custom duties. We have to fight against the best. We have to make ourselves better in quality, in appeal, in cost. This is the way we can survive. And we used to say at Stellantis, the only thing that protects us is performance, and we deeply believe in that.
If that's the case, does that make it harder to keep a production base in places like Italy?
It makes us harder in the Western world, indeed. But in the Western world, we have more knowledge, more experience. We should use our education, our scientific education, our capability to work collectively to find paradigm breakers to compete. It is possible. The 23,000 euro mid-trim EC3 Citroën is made in Europe. Of course, in the lowest cost countries of Europe, but it's made in Europe. It's made inside of Europe.
As you know, sir, the reason I ask is because there are some Chinese producers looking for a manufacturing base in Italy. You, of course, have some production bases there. I wonder if you'd be interested in selling them.
Well, it's a public information that all the European governments are dating the Chinese car makers to come to assemble their vehicles in their countries. So all the European countries, Italy, France, Germany, Spain, they are all dating the Chinese. Fine, so that's a fact. So if you were to ask me, which is possibly your question, would I be willing to sell one of my plants to the Chinese? I would ask you back a question. What is the intention of the European Union if we are encouraged to sell our plants to the Chinese? What will be the sense and the purpose of inviting the automakers of Europe, which represent 14 million jobs, to hand over their plants to the Chinese? Does that make sense for the European citizen? Of course, it doesn't make any sense, which of course we know. So, of course, all business is business. We'll see what the future will bring, but we are here for the fight. We are here to demonstrate that we have more appealing brands, more exciting cars at the right level of affordability, with the right performance and the right safety. So we are going to fight. This is a competition. We love competition. And everything we do for Europe, because the market is much more open than the US market, in terms of competitiveness of our technology, will benefit our American brands, because Stellantis is a global car maker and the technology is available for the 15 brands of the company. Anything we do to compete with the Chinese in Europe or in the rest of the world will benefit, of course, our US brands to bring affordability and performance as soon as we can to this market.
Carlos, you've been super generous with your time. I just want to return to my original question, though. The way you posed your response to that, the conversation that I would have with a policymaker for the good of the European economy and for the good of European labour is a very different one to the CEO of an auto manufacturer. You, of course, are accountable to the shareholder, and the stock is down by 9%, as you know, today. This is a difficult day for Stellantis. So when I ask you a question like, would you sell a production base in Italy to the Chinese? I'm not asking you that as a public official who needs to worry about the size of the European labour market. I'm asking you that as a CEO of Stellantis. Is that a good financial decision for you to make?
It depends if I am making profit out of that facility or not.
Well, you're under capacity there, aren't you?
I will make sure that we keep the capacity above 80% utilization rate. That's the threshold. As long as you are above 80%, you can do a good job.
And you're confident you will be for the next 12 months and beyond?
This is one of the things we have been discussing with the Italian government. They keep on asking us to have a 1 million car production, and I keep on answering that I need 1 million customers. The point is not about the production, the point is about the customers. Now, it is quite clear that if you have 1 million customers out there, and you have to break down the 1 million customers among a certain number of car makers, if you increase the number of car makers competing for the same 1 million customers, it is easy to understand that there will be less cars to be produced. And that is going to open the road to a new context. And in the new context, we'll see what are the decisions we need to make. But at the end of the day, it all boils down to something we know very well in the US. Make the customer happy, period. It starts there. Good quality, good appeal, good affordability, and then you will capture the share of the market that you deserve. And if you don't compete with the harshest competition, then forget it. On the long run, you are going to disappear. There is no other way than to compete with the harshest competition at any point in time.
Carlos, I can tell you this, I'd be very happy if there was a Maserati on my drive, okay? We can leave it there. Carlos, thank you, sir. Appreciate your time. I could talk all day with you. Appreciate it. Carlos Tavares there, the Stellantis CEO. Just a wide-ranging conversation about how difficult it is for an auto manufacturer right now, a global one, when you've got to deal with the politics, the politicians who are looking for one thing, and you've got to deal with the economic reality of where the consumer is at the moment. The tension, the push and pull there, you can feel it. I think Carlos did a wonderful job of really laying that out for us in a very honest, transparent way of how difficult things are right now.
Especially given the fact that he said that Chinese auto manufacturers have a 30% advantage on them when it comes to a cost base of production at a time when a lot of government leaders are trying to figure out how to get around this. His response is the levies, the charges that people are talking about, the gates are not helpful and have corollary side effects that people will not like.
He's climbing two different hills at the same time. One, China, the other, internal politics, whether it's Western Europe, whether it's the United States, this political hope of this EV transition happening quicker than it currently is. And the consumers, he said it right there, are rejecting it. They're rejecting it at the moment.
If you are just joining us, welcome to the program. Got some things to get through, so let's start with the price action. Equity futures on the S&P, negative here by about 0.1%. Bit of a pullback again on the Nasdaq. In the bond market, this big rally that started to emerge at the front end of the curve, it continues. And it continues through the curve. We're down 6 or 7 basis points on twos to 436.47. Down about 6 on a 10-year to about 422. The curve just a little bit steeper. The difference, the distance between a 2-year and a 10-year right now, about 14 basis points. In foreign exchange, all eyes on the Japanese yen. 4 consecutive days of yen strength. The longest such streak going back to March. Dollar yen at the moment, 152.39. Under surveillance this morning, some top stories for you. Israel's Prime Minister Benjamin Netanyahu making his pitch to Congress, defending Israel's war against Hamas and calling on the United States to fast-track military aid. He's set to meet with President Biden and Vice President Kamala Harris later on today. The share of U.S. credit card balances past due reaching a series high in a Philadelphia Fed gauge dating back to 2012. Lisa, you mentioned this earlier. 2.6% of balances were 60 days past due in the first quarter. That's up from a low of 1.1% back in 2021.
The problem with sort of extrapolating out too much from this data is just that it's still pretty low at 2.6%. That said, the trend is remarkable. And the fact that we haven't seen this type of trend is something a lot of people are taking note of. It's the reason why jobless claims today at about an hour time are going to be so crucial in tomorrow personal income and spending, also really setting a tone.
Let's go through that list of data that we get in about 60 minutes. So jobless claims 1, US GDP another, durable goods data, all due in about less than an hour from now. Gurpreet Garrawal of Goldman Sachs writing this in her Q3 fixed income outlook, where we recognize sound economic and corporate fundamentals. We remain vigilant due to stretch valuations and political uncertainties. Gurpreet joins us now for more. Gurpreet, thanks for your patience and thank you for being with us. I want to go straight to this slowdown that we're starting to see emerge, just a sign of it in some of the earnings and some of the pushback we've heard from a former Goldman Sachs colleague, Bill Dudley, of course, former New York Fed president as well, who's come out in the last 24 hours and says the Fed needs to get a move on, that we risk a recession here if they don't cut interest rates. What's your stance on that? How are you and the team thinking about the balance of risks around the Fed's timing of its next move?
Hi, Jonathan. First of all, great to be with you. Look, I would say, we agree the Fed is data dependent, and if that is the case, the data right now does seem supportive of a rate cut. You've had inflation cool down, the disinflation has resumed after a setback earlier in the year. We're seeing a cool down in the labor market. It's not necessarily collapsing. You've seen relatively resilient spending, retail sales and industrial and production data recently surprised to the upside. But on the whole, the data does appear consistent with normalization and pulling back that restrictive policy. Also, if you look at Taylor rule formulations based on the output gap and inflation, they also suggest the Fed should have cut by now. But of course, this is not a textbook economy. What may make sense in theory may not actually be delivered in practice. And our base case assumption is that the Fed is probably going to wait until the September meeting, not next week, to deliver the first cut in this cycle. And, one of the reasons for that is, first of all, they just want to accumulate more confidence in this disinflation path. The second is, at that point in time, they will unveil updated statement of economic projections, the updated dot plot. Back in June, those projections showed PCE inflation, core PCE inflation, higher than where it is at the moment. We have the latest data coming out tomorrow. Also showed only 1 cut projected on median relative to 3 back in March. And so if they're able to unveil updated economic projections and then explain the start of this gradual easing process, we think that's what would be their preferred choice.
Gurpreet, I hear a lot of words. Normalization. I hear about the idea of adjusting restrictive policy. I'm not hearing recession. I'm not hearing anything that suggests that this is going to be just a period of time in a very dramatic downturn in the U.S. economy or the labor market or anything else. How do you decide when the market's gotten ahead of itself in pricing in rate cuts, not just this year, but also next?
Yeah, I think on your first point, the data right now does seem consistent with an adjustment cutting cycle. It's not as if the central bank is needing to cut because you're seeing a sudden slowdown in hiring or sudden uptick in layoffs. You're seeing that gradual cooling. Now, I would caution, our colleagues in Goldman Sachs Investment Research have also highlighted this, that the labor market is rebalanced back to where it was pre-pandemic. And so any weakening from here warrants close attention. But Chair Powell has also told us this. They have noted that the balance of risks to both sides of the mandate are in close focus. I would say right now, what we think is interesting is that you are going to have this gradual easing cycle that is beneficial for fixed income investors. Fixed income yields are going to start to look attractive relative to what you earn on cash, and so that's going to be very supportive for fixed income. I think to your point about what does it mean from here on out, there's a lot of uncertainty for the path in 2025, but I think there's definitely interesting opportunities opening up in the global opportunity set for interest rates, because whilst the response to the pandemic and then the response to the inflation driven by the pandemic and energy shock was largely synchronized, there is no one-size-fits-all approach to these easing cycles, and that's creating interesting opportunities.
Gurpreet, let's develop that idea, because there is this feeling typically that when a central bank cuts rates, it's a good time to go into those debt markets because essentially they're supporting them. So are you going into Chinese bonds? It doesn't seem like people were that enthusiastic with the rate cut over there.
Yeah, look, we look at EM and DM space very differently. I think globally, this concept of focusing on country-specific factors is what is going to drive the opportunity set. In China, you have a different macro regime. You're trying to address structural issues. I think in the EM space, the opportunities are actually more in markets where we have more confidence that the central bank is easing in response to improved inflation progress. And so, you know, Hungary is one space. We saw a cut this year, and other areas as well. And I think in the developed market space, there's greater opportunities in places like Canada. We saw the Bank of Canada become the first developed market central bank this week to deliver consecutive rate cuts. But there's also central banks on the other side of the spectrum in the developed market space. Bank of Japan, steady normalization. Reserve Bank of Australia, unlikely to cut anytime soon. So definitely an interesting global opportunity set, both in DM and EM, and it's driven by country-specific factors.
You say in the coming months you want to reinforce the importance of diversification to mitigate risks. What else could you do in that space to diversify?
Yeah, look, that's a great question. One of the things that we highlighted in the outlook is that you do have strong fundamentals. The economy is still relatively resilient. We're focused on what the picture is of corporate balance sheets as a result of the latest earnings seasons. But of course, you have tight valuations, you have policy uncertainty. And so alongside diversified exposures, be that your rates exposures within credit sectors, other strategies to boost portfolio resilience can include being overweight the US dollar. Tends to be a beneficiary when you have these risk-off periods. Another potential option is to utilize currency options. That's a cost-effective way to position for potential pickup in currency volatility around any associated policy uncertainty. And so, you know, diversification, active security selection, plus those strategies to boost portfolio resilience are all the best way for our clients' portfolios to be resilient to this uncertain environment.
Gurpreet, super smart. It's fantastic to get you on the program. Let's do it again soon. Gurpreet Garawal there of Goldman Sachs on the latest in the fixed income market. High yield spread still in and around 300 basis points. That's super, super tight. Max Kettner of HSBC made that point on this program earlier on this morning. We were talking about big unwind you're seeing in stocks, big rallies you're seeing at the front end of the curve in the bond market, big rally you're seeing in the Japanese yen, stronger yen, and you're thinking about risk aversion, not seeing spreads get wider at all, are we?
You asked a question yesterday, and this to me is the key question. Is this predictive of strength, or is this basically an asset class that has lost its predictive ability with respect to a credit cycle and with respect to economic weakening? And I say this because private markets have offered this huge cushion so that what's left in public markets tends to be higher quality, and people are looking at the all-in yields in a way that is different and really changes the spread characterization going forward.
If you think about the conversations that you and I used to have together literally more than 10 years ago on Bloomberg TV, I'm aging us here, I'm sorry. we talk about how cyclical the index was, this big energy tilt. Do you remember that?
Yeah.
It's changed a lot in the last decade.
Yeah, it's actually shrunk dramatically. And think back to 2014, 2015, energy, shale, that was so stress tested that a lot of those names were kicked out, bankrupt, et cetera. The ones that survived were much stronger. The ones that have continued to be in that index tended to have been the survivors. And that is the reason why, yes, you are seeing a gapping out in the lowest quality of names. But other than that, you see some of the tightest spreads going back years.
Get told repeatedly all the time by a lot of people in this market, it's a high quality index. It's changed over the last few years. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. IBM shares up more than 2% in the pre-market. It reported a jump in its bookings for its AI business. IBM says bookings for AI consulting and software since mid-2023 have now exceeded $2 billion. Second quarter sales increased 2%, almost $16 billion. That beat the average analyst estimate. Boeing has agreed to plead guilty to criminal conspiracy over 2 fatal crashes of its 737 MAX jetliner. Details of the plea deal were made public in a federal court filing yesterday. In that agreement, Boeing faces a fine of at least $243 million. It will serve 3 years on probation with an independent corporate monitor. Boeing will also spend at least $455 million to bolster its compliance and safety programs. The Justice Department said Boeing violated a deferred prosecution deal after the blowout aboard an Alaska Air 737 MAX 9 jet on January 5th. And it was a chaotic finish, to put it lightly, to the opening match of the Olympics men's soccer tournament. Down 2-1 to Morocco, Argentina appeared to score a dramatic equalizer in the 15th minute of injury time. Morocco fans then stormed the pitch to protest the goal, and the match appeared to end in a 2-2 draw. 90 minutes later, with the stadium empty, news broke that Argentina's goal had been ruled offsides. The players then returned to the pitch to play the final 3 minutes. Morocco held on to the 2-1 win. And that's your brief. John.
I think the New York Times called this a circus, and I think that's fair to say that's what it was. Danny, thank you. Up next, Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion, L-Y-I-N apostrophe.
These extremists want to take us back, but we are not going back. We are not going back.
From New York City, that's up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 negative here by 0.2%. Rally in the bond market, yields lower by 6 basis points. 422. 32 on 10s. Under surveillance this morning on the politics, it's Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion, L-Y-I-N apostrophe. The most incompetent and far left vice president in American history.
I believe we face a choice between two different visions for our nation. One focused on the future, the other focused on the past. These extremists want to take us back, but we are not going back. We are not going back.
So here's the latest. Donald Trump ramping up his attacks on Kamala Harris, criticizing her record as San Francisco district attorney and her stance on abortion rights. Harris taking aim at Trump and the GOP's ties to Project 2025. Libby Cantrell of PIMCO saying this: while Trump remains favored to win at this point, his chances, as well as the odds of a Republican sweep in Congress, are now lower than they were just last week. We now view the election as more dynamic, with likely more twists ahead. Libby joins us for more. Libby, I can't imagine what those twists might be, so let's not even entertain that. I've got a poll in front of me. It's just dropped, so allow me to share it with you. It comes from Emerson College, and it reads as follows. It's on swing states. In Arizona, 49% support for Trump, 44% for Harris. Georgia, 48% support for Trump, 46% for Harris. In Michigan, 46% for Trump, 45% for Harris. Pennsylvania, 48% for Trump, 46% for Harris. Wisconsin, they are tied in Wisconsin at 47% support, Harris and Trump, respectively. When we start to get polls like that, more polls like that in the coming days and weeks, how much weight do you put on them in the early days and weeks of this contest?
Yeah, so I would say that not a lot right now. I think that the polls will be much more telling if, after the convention and then really in September. And this is what we had been telling clients even before all this drama, is that really wait until September, because that's when just statistically polling becomes more predictive. Obviously, polling's never going to be completely clairvoyant in terms of who actually shows up to vote, but it becomes more predictive as you get closer. So, and I say especially this because it is so dynamic, because she really is reintroducing herself to voters. That's good and that's bad. I mean, she has a very progressive record that she ran on in 2020 that she's going to have to sort of defend and clarify and what have you. But I wouldn't necessarily, I would take all of this polling with a big grain of salt. So really, after the convention, really wait until September. I always tell clients, like, have a cocktail, go to the beach, enjoy your vacation, and then come back to politics in September, because that's actually when I think it's really, will be much more indicative.
It's hard to have a cocktail given the past few weeks that we've been dealing with in U.S. politics, but now there's a lot of emphasis on who she's going to pick as her running mate. Who do you think is best for her? Not just to support her and expand her views, because you say she is very progressive, but also the math when it comes to Electoral College.
Yeah, and so, I mean, is she very progressive? We don't know. I mean, just to clarify, I mean, she ran on a very progressive platform when she was running the Democratic primary. Yeah, yes, no, and again, she was running for national office even when she was in the Senate. So for sure, she has a progressive record. I think that's the thing, though, it's unknown about her, is where does she stand on many of these issues? But you're absolutely right. Her running mate is going to be a really, really important, both because it is sort of the first public decision that she is going to make, and oftentimes, you know, picking your running mate is really a reflection of the top of the ticket's judgment, but also, as you talk about, is really the Electoral College strategy. Arizona, as John just said, I mean, she's lagging in Arizona. Mark Kelly, the senator from Arizona, who's more moderate, particularly on border issues, that's going to be a big liability for her, but also could help shore up support in Arizona. And then Pennsylvania, I mean, if of all those 6 states that you just mentioned, Pennsylvania is going to be the most critical state for if the Democrats are going to win. They have to win Pennsylvania. And it's necessary, but it's, you know, necessary but not sufficient. I mean, they will have to win other states as well. But if they lose Pennsylvania, Democrats have lost this race. So Josh Shapiro, the popular governor, who also has a more moderate stance on things like fracking,
which she had said she was going to ban. So
yes, no, exactly. And she says she's talked about Medicare for all. She's talking about defunding the police. She's talking about banning fracking. I mean, again, she has a platform that will be untenable for her to run on and win. And that's why I think she will need to start clarifying much of that. Now, the other challenge is that she's vice president and current sitting vice president, and she can't necessarily distance herself so much from Biden as well. So she has a lot of challenges, a lot of twists and turns ahead in terms of really navigating like the policy front.
You said the top of the ticket is the judgment of the candidate. What does that say about Trump and his pick of J.D. Vance?
Yeah, well, as we were just talking about, I mean, this decision to pick J.D. Vance was really a moment in time, right? It was on the heels of the assassination attempt. It was when Biden was still in the race. It was when folks had odds of Trump winning at 75, 80%. Republican sweep looked more likely than not. And so he wasn't necessarily as concerned about expanding his voter base. He wasn't as concerned about it as being tight as it might end up being. So, we'll see whether he, how he feels about that J.D. Vance, but it is much more a doubling down on kind of MAGA and on Trumpism than, say, a Doug Burgum or even a Marco Rubio or certainly a Nikki Haley, some of the other folks who were in the mix.
So you note that Michelle Obama is still not going to be the nominee for the
I saw
Democrats.
that in the notes.
Okay.
So sorry to break it to you.
Hold on a second. Well, but hold on a second.
Who that was for.
Okay, evidently that was for us. But I'm not going to ask you about Michelle Obama. I don't think that I was the genesis of that. I do want to ask you, though, about the tenor of the discussions that you've been having with clients overseas, outside of the U.S., how they're viewing this, how that affects their investment decisions, what questions they're asking to understand the potential ramifications of this.
Yeah, so actually, I'm still getting questions about Michelle Obama from our Asian clients and about Jamie Dimon. So, hope springs eternal, I guess. So I would say they're sort of in two lanes. One is around fiscal, and of course, a lot of our clients overseas have a lot of dollar and a lot of treasuries exposure. So just trying to navigate that. And I think, as we've talked about, really the punchline here is that the deficit is the biggest loser in November. So regardless of who wins, the deficit will remain high. And not only because there might be new spending and there might be more tax cuts, although I think that's going to be difficult just given where deficits are right now, but mostly because, as we've talked about, there won't be entitlement reform, and that's what you really need in order to, to consolidate sort of the budget and what have you. And the other concern they have is, of course, around geopolitics. And interestingly, mixed views here, because I think a lot of folks in Asia think that, well, at least President Trump, we can negotiate with him, whereas maybe a Biden or Harris may have more of an ideological view. So I'm not sure that's right. I mean, again, I think the direction of travel here around tariffs, around export controls, around even capital flows, around scrutiny around how U.S. investors invest in China is going to be sort of pervasive regardless of who wins. So in some ways, my view is there may be fewer distinctions than folks think, but that's really where our clients are focused.
The message from PIMCO: get a cocktail, enjoy the beach.
Yes,
sort of
that's what she tried last week. How'd that work out?
Yeah, I mean, not well, I will tell you. Yes, this is what I'm trying to do. It's sort of self-soothing, but it's not really working out very well.
Thank you. I like that advice.
Libby, it's good to see you. Thank you.
Thanks.
Libby Cantrell of PIMCO on the latest. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to the former New York Fed President, Bill Dudley. Bill, in the headlines, had a big way in the last 24 hours with a big call to cut interest rates this month. Bill's just around the corner, as is Michelle Girard of NatWest Markets and Gennady Goldberg of TD Securities. Your equity market on the S&P 500 slightly softer. It's been a difficult week from New York. This is Bloomberg.
The top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We're at a point right now where I think we can all agree the economy is slowing.
There's some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I got to say, we've never had this intensity of debate between bulls and bears.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
What a 24 hours it's been in this market, and it continues. So let's pick up on some of the price action for you and start in the equity market. Futures negative here by 0.25% on the S&P, following the biggest one-day loss going back to 2022. Likewise on the Nasdaq 100, down by about 1/3%. Just a little bit of weakness, nothing too dramatic. In the last 24 hours, though, big rally at the front end of the yield curve. The 2-year yields lower again this morning. So let's talk about the why. We could talk about the data. It drops in about 29 minutes. I think we need to talk about the commentary coming from a former Fed official, former New York Fed President Bill Dudley, who says he's changed his mind. They need to reduce interest rates this month. Bill joins us in about 15 minutes' time. Do not miss that conversation. And it's hot on the heels of a conversation we've had with Mohamed Al-Erin a few times on this program, that he thinks they need to make a move in July. This is what Mohamed has to say on Bloomberg Opinion today. Failing to ease policy in either July or September, an outcome that unfortunately can't be ruled out, would constitute another policy mistake for a Fed seeking to restore its credibility after fumbling the initial response, Lisa, to building price pressures back in 21.
The fundamental question right now underpinning some of the commentary as well as the action that we're seeing in markets is how much of this is fundamental? How much is this true weakening that goes beyond just a normalization in the economy versus positioning reset versus technical versus a market that has seen its longest streak of wins going back years and up for 28 weeks of 38, which is something that hasn't been exceeded since 1989. This is a tension point at a time we don't have a clear view of how quickly the labor market is weakening.
That Dudley commentary, though, being picked up. Andrew Hollenhorst this morning. Fed focus has returned to the labor market, reflected in the Dudley opinion piece, who we'll be speaking to, and the Fed should cut rates next week. Jobless claims in focus this morning, but it may take until August to confirm a concerning trend versus a seasonal fluctuation. That's really a debate.
Far more interested in claims in about 28 minutes than I am GDP. I think Andrew Honlehurst of Citi speaks to that. To your point on the price action, we can do this cross-asset, we can do individual names. Cross-asset, we've described this a few times as just a massive unwind of consensus positions that you see in equities, you see in bonds, you see in foreign exchange. Everyone short the Japanese yen, all of a sudden things whip in the other direction. Dollar yen negative for 4 consecutive sessions. But within stocks, there are these company stories that start to add up. Just the consumer starting to push back. We saw it with Delta. We saw it with United. American has been a messy, messy story of execution misses over the last 12 months or so. But American again this morning, American Airlines having a difficult time. That's the airlines. Look at the auto manufacturers. The consumer's in one place, their production's in another. Ford's a big struggle. Stellantis is a big struggle. It's industry after industry in the last couple of days.
Where basically they can't raise prices as quickly as their input prices are rising. We heard that also from Nestle. This is a global story of margin compression and, frankly, consumers pushing back. This is the reason why not only today's jobless claims, but tomorrow's consumer spending numbers that we get will be important to give a sense of just how persistent this will be, given the fact that some of these airlines, and I'm thinking of American in particular, is down already 26% so far this year. The fact that it's down another 6.3% as it ratchets back its profit forecast for this year shows maybe people aren't really pricing in a low enough bar for some of these consumer-facing companies.
It's a bad time to report bad news, that's for sure. Then we said that earlier this morning. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as the S&P 500 sees its worst day since December 2022. We'll speak to the former New York Fed President Bill Dudley on his call for an immediate rate cut, and Michelle Girard of NatWest reacting to GDP data and jobless claims, which drop in about 25 minutes' time. We begin with our top story, the AI frenzy losing some steam. A global tech sell-off pushing the S&P 500 lower as investors reassess the AI trade. Cameron Dawson of New Edge Wealth saying there's still time for a turnaround. Writing this, is tech dead? No, but it needed this breather. Tech went parabolic and got aggressively overbought at the beginning of last year. Tech can correct, support, and will remain and still remain in an uptrade. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
What is this that we're seeing? Every single guest we've started the hour with, we've asked the same question. I'd like your opinion to the same question. Is this a rotation, a broadening out? Is this an unwind of consensus trades? Is it a growth scare that's starting to emerge? How would you describe what we've seen?
I think that there is very much a technical aspect. We got incredibly overbought, mostly in tech and growth. And I think the important point is the last 3 months of that move really didn't have anything to do with earnings moving higher. It was all valuation. So it was sitting on really fragile ground. You saw positioning get really one-sided. Everybody moved to the same side of the boat, whether we're looking at things like CTAs in the 99th percentile, households being just 1 percentage point away from peak positioning. So you had the setup for very high expectations, stretch valuation, stretch positioning, and this is just a digestion of that. The question is, do we have an earnings deterioration because of what we're seeing in inflation data, because of what we're seeing in growth data? If we see that, this is more protracted and it's deeper. If not, this is just short, shallow like we've seen over the last year.
Next week, Amazon, Microsoft, Meta, Apple. How low is the bar or high for them going into next week, given all of this?
I think based on valuations and positioning, the bar is very high. And we can see that throughout this earnings season, which is that there is absolutely zero tolerance for anything that even smells of weakness because positioning is so stretched. Now, this is good to take the air out of some of these areas simply because it allows you to potentially, over the medium term, extend the rally. We went truly parabolic in growth versus value in June and the beginning of July. It was going to end, and so this is good and healthy to shake out weak hands.
That said, it's one thing to look at specific companies and understand whether they're facing a good profit outlook or not. It's another thing to extrapolate it a larger macroeconomic story, and you kind of can't avoid it when you hear the same thing from company after company about pricing pressure and consumers pushing back. How much of a normalization versus a true weakening is this?
I think it's so important because the deterioration in CPI, or the falling in CPI, which is good for the Fed, actually makes 2025 earnings estimates less likely. The lower inflation is, the less margin expansion and the less top-line expansion we're going to get. We are hearing across the board that companies are having issues with pricing power. They are not able to pass on input cost increases to their end customer. This is very different than 2020 and 21. We saw input cost increases, but you were able to push that onto your end customer in a blink of an eye. customers are now pushing back, which just means that that $277 a share that is now forecasted for 2025 earnings, we think is far too high.
Given that, are people conflating the idea of earnings coming under pressure, margins coming under pressure, with an economy that's truly rolling over?
I think that that is the key distinction, which is that it's deceleration, not necessarily falling off a cliff. And we see that in the labor market as well. You're seeing these signs of fraying, but you're not seeing an outright surge in the unemployment rate higher. You're still hearing talk of labor hoarding from the likes of the NFIB, the Conference Board. People are still saying that they're having trouble finding workers, which would suggest that you're still in this normalization, not necessarily outright weakness. It's slower growth, but not necessarily growth that's falling off a cliff. The challenge is, how does that compare with consensus? Because consensus is still expecting really robust growth, acceleration in top-line growth next year. I think that's where the two come to meet heads.
You also have an election call. What's your biggest probability you're watching that could be the biggest cause of concern for 2025?
I think it's about sweeps. It's if you see the probability of a sweep, whether it goes Republican or Democrat, and we know that we're seeing these probabilities of who gets elected start to swing around pretty materially. But I think the sweeps is what the market is going to be the most concerned about, because it would allow the most extreme portions of policy agendas to get pushed through. So those are the parts of the policy that could be the most inflationary or possibly be the most exacerbating of high deficits. So if you see stalemate, then I think that's the outcome that the market breathes the most sigh of relief.
And how do you prepare for that? Or you can't until November 6th?
It is hard to prepare, because what we tend to see going into elections is you pull forward a lot of performance. You have this expectation that certain areas will benefit. It doesn't necessarily translate into earnings, meaning that you can see run-ups in different baskets of stocks prior to the election, and then it becomes a sell the rumor, buy the news kind of situation.
Let's put a bow on it. You said the uptrend can remain intact. What gives you that confidence?
Well, we still have room to pull back to trend. We still see overall that the economy isn't falling off a cliff. We reserve the right to change our mind. The market is not oversold yet. And I think that's an important point here, is we think that this correction continues. You can measure it by looking at the RSI. We're not externally oversold. Internally, look at the percentage of names above the 50-day moving average. It's still at 58% for the S&P 500. That usually goes down below 20% in a true durable low. We think that there is more chop to come, but you are still in a medium-term uptrend that remains resilient. You were back in October of last year. You were back earlier this year when we had corrections. So seeing that medium-term, long-term view remains very important.
Futures negative by 0.2. Cameron, appreciate it. It's good to see you. Thank you. Cameron Dawson there of New Edge Wealth. This note just drops. It comes from Baird. Apple price target raised over at Baird. New price target 240 was 200. Here's the quote. We believe Apple Intelligence could provide a much needed upgrade catalyst, boosting revenue and EPS growth meaningfully. Apple also had a difficult session yesterday, Lisa. There's some pushback from the South side. An upgrade.
Here's the real ultimate question, and that's why our conversation with Valdemar earlier this morning, Valdemar, was so interesting, of KKR, which is it's a matter of timing. How quickly some of this AI technology and sort of other types of technological advancements can become profitable. And a lot of people are doubling down and saying this is a bigger revolution than the internet was.
I'll let you know the big tell. It's when I upgrade. You know, getting the itch a little bit.
You're the bellwether.
Without a doubt. If it happens in September. This note is about people like me who've got iPhones that are years and years old and have just sat on them and
You're the
haven't
main
upgraded.
character.
Let's
Absolutely.
I'm always the main character.
I know. Well, can you then, you need to come in and say, I'm going to upgrade.
Aren't you the main character in your story? Isn't that what life's about, Bramo?
Absolutely.
Let's get you an update on stories elsewhere. With your Bloomberg Brief, the main character of this show is Danny Berger. Hey, Danny.
Hey, John, thank you for that. Southwest Airlines reporting a better-than-expected second quarter profit, seeing a boost for summer travel. Shares still down 4 1/3%, though. The airline is also introducing a change to one of its defining passenger experiences. Seats will now be assigned as the company ditches its free-for-all policy that's been in place for decades. The change comes after it was under pressure from activist investor Elliott Management, which says the airline has failed to modernize its business to appeal to customer demands. For the first time in 4 years, Royal Caribbean Cruises is reinstating its dividend. It's the first cruise operator to do so since COVID ground the industry to a halt. Now record demand is putting it on firmer footing. Royal Caribbean will pay out a quarterly dividend of 40 cents per share. Meanwhile, robust growth means it's reached its financial targets 18 months ahead of time. And Gen Z is showing its support for Kamala Harris. Vote.org reported that nearly 40,000 people registered to vote in the 48 hours after President Biden dropped his re-election bid. 83% of new voter registrations were for people between 18 to 34 years old. It's the largest number of registrations in a 48-hour period this election cycle. And that's your Bloomberg Brief. Back to the real main character.
Hardly. Danny, thank you. Everyone's a main character. Isn't that a Joe Rogan line? I think that's a Joe Rogan line.
I have no idea. All I know is
what would the main character do?
All I know is that this is sort of disclosing too much, but at home I was having a discussion with my son, and he said to me, "Oh yeah, you're the main character."
Is that where that comes from? I'm pretty sure that's a Joe Rogan thing. It talks about, like, if you were the superhero, what would that person do?
Everybody
like
should be.
In the movie,
but everybody should be in their own life. You know, that's an important thing. If you're not, I mean, who's going to be for you?
The problem is around this table, I think everyone just has main character energy.
Is that what's going on around here? This is a good time to go to break. Cameron wants to run. Up next, the morning calls, plus conversation you don't want to miss. Former New York Fed President Bill Dudley on his big call for why the Fed should cut right now. That's next.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities on the S&P pulling back by 0.25% on the S&P 500. The rally in the bond market continues. We're down almost 8 basis points now on a 10-year to 420.76. The rally at the front end continues as well on the 2-year. We're down about 6. The data drops in about 14 minutes. Let's get you some morning calls. First up, TD Cowen lowering its price target on Chipotle to 65, keeping a buy rating. The firm saying it appreciates management's attention to improving publicity regarding portion sizes through operational changes. The stock is up by a little more than 1%. Your second call from Barclays lowering its price target on Ford to 16, maintaining an overweight rating on the stock. The analyst noting the automaker's significant second quarter miss, which was disappointing versus elevated expectations. We're down there now 13%. And finally, Citi downgrading Lululemon to neutral with a $300 price target. The firm seeing slowing spending trends in the active apparel space, also noting likely promotional pressures in the second half. They're down about 3% in early trading. And looking ahead to next week, here's the big call of the last 24 hours. Former New York Fed President Bill Dudley saying this: officials must cut, and they must do it now. Dudley writing in Bloomberg Opinion the following: the facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting, although it might already be too late to fend off a recession by cutting interest rates. Dawdling now unnecessarily increases the risk. Bill joins us for more. Bill, wonderful to go on this kind of journey with interest rates with you, because I remember at the very start of the conversation coming out of the pandemic, you were one, together with the likes of Mohamed El-Erian and Larry Summers, warning that there were going to be inflation pressures and this Federal Reserve needs to hike. You've changed your mind, Bill, and in the piece, there are several points you've made as to why you've changed your mind. I want to pick up on what I think was the third one, the labour market. Bill, what's happening there that's guiding this call?
I think you can see the labor market is slowing, especially evident in the household employment survey, which is much weaker than what we've seen in terms of payroll employment. Over the last year, household employment's increased by less than 200,000. I think the labor market, the second part of the labor market story is, of course, the rise in the unemployment rate. We were at 3.6% a year ago. Now we're at 4.1%. And these kind of rises in the unemployment rate are essentially warning signs. Every time the unemployment rate has gone up by more than 0.5% on a 3-month moving average basis, the U.S. has had a recession. This is a so-called SOM roll. Right now, on the SOM roll basis, smoothing it, 3-month moving average, 0.43% increase. So we're getting very, very close to triggering the SOM roll. You know, Chair Powell himself has pointed out the risks now are very much two-sided, not one-sided. Inflation is much more benign, 2.6% for the core PCE deflator year over year, and we're probably going to get another good reading on Friday. So I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
Bill, let's talk about timing then. This was Chairman Powell in Sintra, Portugal, so not even a month ago. He said, we have the ability to take our time and get this right because the US economy is strong and the labor market is strong. Based on your piece, just on the timing, they might already be too late to fend off a recession. Why are they miscalculating how much time they have, in your opinion, even though they have acknowledged what's developing in the labor market?
Well, I think they put not very much weight on the SOM roll. SOM roll's perfect track record since World War II, 13-0. But their view is that the reason why the unemployment rate's going up is because labor force is growing rapidly. So that's not as disturbing as if the unemployment rate was going up because people are being laid off. The problem with that story is that in the 1970s, we had labor force growth that was also extremely rapid. SOM roll held. So I think you want to stick with the SOM roll until it's disproved.
That said, Claudia Sahm of the SOM roll has actually come on and said, people put too much emphasis on my SOM roll, and actually backed away from using that as one indicator to really end all be all. Is there anything other than that that creates new urgency for this sudden pivot, really a week before the Fed's meeting?
Well, you know, if the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment and investment. So the striking thing about the SOM roll is not just the 0.5% threshold, it's the fact that every time you've gone through that threshold, the unemployment rate's gone up a lot. The smallest increase beyond, when you go beyond 0.5% is almost 2 percentage points. So that just tells you that once things start to unwind in a negative direction, it tends to keep going. And that's why the risk here is significant.
Bill, your column got a lot of attention, and in large part because you were on the forefront, as John was mentioning, of this idea that the Fed would have to raise rates much beyond what people currently thought at the time, and that maybe even the neutral rate was going to be higher than what it was in the past. Based on the weakening that you've seen, are you rethinking that concept that inflation is going to be structurally higher and that the Fed's going to have a harder time combating it in the future?
Well, if the economy slows and the unemployment rate rises, then the downward pressures on inflation are going to persist. 2.6% is really not that far away from the Fed's 2% inflation objective. And in my mind, that difference is not sufficient to take a big risk of a recession. So I think it's time for the Fed to focus on the other side of its dual mandate, which is the employment side. Powell has talked about the fact that the Fed has two objectives, inflation and employment. And I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
Bill, are there things you can say as a former Fed official that you can't say as a current Fed official? I'm just interested in the communication of this. You can speak your mind now freely with us. You can write the piece on Bloomberg Opinion. Can you imagine what the fallout would be if we had the current New York Fed president or the chairman of the Federal Reserve saying the things that you're saying right now at the July Fed meeting? Do you think they can even do that, even if they thought it?
Well, I think if Chair Powell was of the view that shared the same view as me, I think he would probably talk to the other officials and develop a consensus to move in July. I mean, I think one of the interesting sort of quandaries of the Fed is right now they've telegraphed it pretty clearly that they're going to move in September, and it sort of begs the question: if it's so obvious that you need to move in September, then what are you waiting for? Why not just move in July?
At this point, there are a lot of people who are associating political reasons for why someone might want to come out and say that now is the right time to cut. Since the data hasn't weakened that dramatically in the past couple of weeks, we have seen an ongoing deterioration that seems consistent with a normalization. Bill, how do you counter those accusations that this is being done ahead of an election, highly contested, where if the economy can keep doing okay, typically the incumbent or the incumbent party does better?
Well, I think my experience, and I think this is borne out by the Federal Open Market Committee transcripts over many, many years, is the Fed doesn't take politics in consideration at all in terms of this timing of monetary policy, rate increases or rate cuts. And I think that's the appropriate behavior by the Fed. They need to be independent. They don't want they shouldn't be taking the election cycle into consideration. And I don't think the Fed is doing that here. I think the reason why the Fed is delaying is I think they were surprised last year when they thought inflation was going down, and it turned out we got a number of disappointing readings on inflation. I think they're also probably waiting because Powell probably wants to achieve a full consensus. I think he'd like to see a unanimous vote in favor of easing. And the hawks may be, there may be some people who are hawkish on the FOMC that are still a bit reluctant. I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
Hey, Bill, it's great to catch up with you, sir. Appreciate the insight. This piece yesterday on Bloomberg Opinion got a ton of attention. The former New York Fed president and Bloomberg Opinion columnist, Bill Dudley, there on his call to start cutting interest rates like yesterday, right now.
And he talked about the Somme rule. He talked about how it just the balance of the mandate just seems like the labor market should take on a greater degree. I just want to take it a step further, though, this idea that how much does the Fed not want to seem like they are perceived as being political? How much of a push that becomes for them not to cut rates, even if they feel like the economy might justify it?
They want this smooth glide path. They always do. They want this smooth communication. They don't want to rattle people with sudden turns and big decisions that seem to come out of nowhere. So they're setting us up for September. I think the risk here between now and September is a risk that Mohamed Al-Erian has highlighted, that they've been so data point dependent, and this is the point that Neil Dutta made recently on this program, that it wouldn't take much to spook them. You get one hot CPI print, and maybe they back away from September, and that's the ultimate risk here.
You get one bout of commodity inflation that causes a CPI print to look hot. All of a sudden, it's really difficult.
So the distance between a rate cut and not a rate cut apparently is a couple of months. End of July and September. It's that big deal? We'll talk about that in a moment. The data drops next.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
"60 minutes away from the opening balance, seconds away from a ton of economic data. Mike McKee's in the studio. He'll break all that down for you. The scores look like this on the S&P 500, pulling back a little bit. We're down 0.25% on the S&P. We take some more weight off the NASDAQ. We're down 0.4% after yesterday's big sell-off. The bond market is rallying into this data. The 2-year, the 10-year, the 30-year yields are lower across the board from anywhere between 6 and 8 basis points. The 10-year's down 8 at 420.37. With that economic data, let's get across to Mike McKee. Morning, Mike.
Good morning, John. Well, we have an upside surprise to GDP, 2.8%. The forecast was for 2%. Consumer spending comes in at 2.3%, certainly stronger than the 1.5% last time. I know, John, you've been dying to hear what's happened with jobless claims. 235,000, so we get a drop of 10,000 from a revised 245. There was talk last week of the jump that we saw being because of Hurricane Beryl in Houston, and that may have been the case. We'll look at where the big changes are. Durable goods orders down 6.6%. However, capital goods orders, non-defense, ex-air, up 1%. Remember, it was down by a 0.6 margin last month, and the expectation was for just a 0.2 gain. So business spending looks strong, consumer spending stronger than expected, GDP stronger than expected, and Bill Dudley says they got to cut rates. So, I mean, if you're at the Fed, you're just throwing up your hands going, I don't know.
Look, this debate's not going to change based on this economic data this morning. The pricing of everything might, though. Equity futures at the moment look a little something like this. We fade some of those losses. We're down 0.2 on the NASDAQ, down 1/10 on the S&P. We fade just a little bit of the rally in the bond market, just a touch. Yields were lower than this. They're still lower, still down on the day, but not as low as they were. We're down 4 basis points on a 2-year. On a 10-year, we're down about 6 basis points. Jobless claims, jobless claims, jobless claims. All the labor market data between now and the Federal Reserve's next decision is the difference, Lisa, between having time and running out of it. And if you look at that in isolation this morning, the picture around claims a little bit better. The people who are in the camp that they have time have a little bit more data behind them.
And the people who say that they don't have time will say that things can happen very quickly and that you've seen a gradual kind of weakening. This is data that makes it a lot more complicated and difficult for the Fed. And I would say that that's what you see, especially given the fact that when you look at the internals of this GDP print, you're seeing an upside surprise to the core PCE price index over the 3 months. So we're looking at a really pretty strong read there at a time where jobless claims aren't falling out of bed, even though there are other signs broadly in the soft data pointing to a dramatic weakening in certain sectors. This data doesn't show it.
Mike, you'll have some time to go through all of this line by line, but just an early read on things. That GDP surprise, that positive surprise, what's underpinning that?
Well, it looks at this point like what we're seeing is strength in consumer and business spending as opposed to an inventory kind of thing, although inventories appear to be bigger. I'll get those numbers in just a second. One thing I did want to point out, the price index for the quarter, which the Fed doesn't pay as much attention to because it's a quarterly average, comes in at 2.3%. That is significantly lower than what had been anticipated before. The second quarter PCE, 2.9%, I'm sorry, annual rate 2.7%. That will give people the idea that we're going to get a decent number tomorrow.
At this certain point, it's not about whether or not the economy is falling off a cliff. It's about the balance of risks for the Federal Reserve in terms of the labor mandate and the inflation mandate. Is there enough confidence, given the fact that there is an upside surprise in this GDP print to the inflation metric, that you're seeing jobless claims actually go down from last week, so potentially the distortions you were talking about? Is there anything in this data to suggest that the inflation beast has been slayed and that that's sort of an ancillary question and that really the focus is still squarely on jobless claims?
Well, I would go back, John knows Hammer Films in London with all the Dracula movies, and they'd kill it, and it would, you just pull the cross out and they'd come back again for another movie. That's what the Fed is afraid of at this point. You can't say it's been slain, but you can say that things are definitely getting into the territory where the Fed has said it would cut rates. Now, when you look at the GDP numbers, you have to figure that it would probably take a July surprise off the table, because the GDP is strong and the PCE numbers are going down. I mean, on a quarterly basis, 2.3% for the headline and 2.0 is their target. So they're getting pretty close here. So at this point, you have to figure that if they do anything, they'll be setting us up for September. And you were talking about the yield curve earlier. I mean, the markets have priced in a July cut, essentially. So they don't need to cut to get the effect that they're looking for.
Just how dark are these conversations you have with Fed officials down in D.C.? What are you talking about? I know, seriously. Scary stuff. Mike McKee is going to stick with us. Michelle Gerard of NatWest joins us now for more. Michelle, only 15 minutes ago, we just had a conversation with Bill Dudley, who was making the case to cut interest rates in July. You're making the case that they're going to cut in December. You've got some additional information. Why does this picture this morning validate your stance?
Well, let me just begin by saying we have backed off or pushed off our call for a Fed rate cut pretty consistently over the last year. We had been expecting the economy to be weaker and the Fed to be cutting rates sooner. We've had this December forecast in for a while, though the data and the rhetoric have mounted to suggest it could come sooner. We've just got a lot of information, as this morning's numbers suggest, the employment numbers next week, which I think needs to really fall into line before we would confidently say, all right, we should move from December to December, having been burned many times before. I think what Mike said was exactly right. The numbers this morning take away the risk of a July surprise. It removes the urgency for the Fed to have to act. Next week's employment data will be very important. The claims numbers this morning, again, kind of complicating the picture for the Fed. Next week, we've got a forecast for 170,000 gain in employment and unchanged unemployment rate. Complicates the picture again a bit for the Fed in terms of just how urgent does the Fed feel they need to act. I think the data that we'll see between now and September, we don't rule out September at all, but we just don't want to get whipsawed as we've been so many times like the markets this year.
Michelle, if unemployment crept higher, and this is really a little bit of scenario analysis, I just want your opinion on how they might respond to this. If we triggered the SARM rule going into this meeting, I just wonder how they might respond to all of this. How would you expect them to respond going into September if we triggered the SARM rule? How would things change?
Well, again, even as Bill Dudley points out, the reasons for the uptick in the unemployment rate are not quite as worrisome. It doesn't suggest that the labor market has imploded, obviously with labor supply increasing. So I don't think the Fed would want to appear panicked. They've set I think the train in motion in terms of setting the stage for a September rate cut. Even if we were to get a sharp upside surprise, or I should say a negative surprise in terms of the economy and upside surprise in the unemployment rate, I don't think the knee-jerk reaction would be to want to cut rates in July. Again, the Fed doesn't want to appear panicked, particularly when the underlying breadth of data do not suggest the broader economy is falling out of bed. So I would still expect that they would keep on the same path. It would just clearly the odds of a move in September would ratchet up dramatically, and the rhetoric at the Fed meeting, as well as the Jackson Hole, obviously, conversations in August would certainly, I think, definitively set the stage for action in September.
Michelle, just taking a step back, do you think that overall the balance of data suggests that the balance of risks for the Fed are much more squarely focused on the labor market right now, and inflation is much less of a consideration? I
don't know if I would go so far as to saying we've shifted from with the two concerns or mandates now more toward the employment or economic situation than inflation. I mean, you clearly have seen the Fed move from focusing primarily on inflation to a more balanced approach and looking at both of the risks. And I think that that's, appropriate. I think also stepping back, as you say, and looking ahead, we've mentioned the politics. I mean, clearly the timing of the election may, on a near-term basis, factor into the market's discussion, at least, about the timing of a rate cut. But when you think about the implications, perhaps, of a Trump presidency and the potential for tariffs, which could increase inflation, there are offsetting risks on the inflation side as well. Yes, we've got a downtrend in place. The Fed's growing confident that downtrend can continue. But when it looks more broadly, there are risks to the inflation outlook under certain political scenarios, and that too has to factor in. So again, I think where the Fed is, where they're looking at both risks as relatively balanced, and I think that's probably appropriate.
How much do you think, though, the markets would sell off if the Fed didn't cut rates at this point in September?
Again, I think it would be a disappointment, and I think you'd see the markets react. But it does get back into the messaging around it. If for some reason there's just an expectation that the move has been delayed to December as opposed to September, and the Fed is still on the path, clearly the market's going to be disappointed because it's pricing in almost 70 basis points of rate cuts this year. So if they don't move in July and September, and you're only going to get one cut in December, the market has to reprice for far less easing this year. But as long as I think the markets are anticipating that the next direction in terms of the Fed taking action is to cut, that there is some underlying support there that would be sustained.
Michelle, sticking with December, just about for now. Michelle Girard of NatWest, appreciate it. Thank you very much. Let's turn to the bond market. I just want to sit on the 2-year just for a moment. The 2-year at the low of the session, the yield was down about 9 basis points, now down about 3. Economic data better than expected, just pushing back some of these calls for that imminent rate cut to take place, maybe even as soon as this meeting in July. Mike McKee still with us to break this down. Mike, GDP, durable goods, there's a lot in here, claims as well. What stands out for you?
Well, let me just quickly dispose of the durable goods issue in terms of headline number coming down 6.6%. Non-defense aircraft, Boeing, 127% decline. I wouldn't want to be in that business that way. Talk about volatility. But then you look at the GDP numbers, and it's personal consumption 2.3%, non-residential fixed investment up 5.2%. Most of that was equipment, 11.6%. Structures were a big deal last year. This quarter, they were down 3.3%. We've built the factories now. They're putting the equipment in. So this should start to have an effect on the overall economy going forward. And then finally with GDP, big drop in net exports that subtracts about 7/10 overall from GDP, but inventories added 8/10. So they kind of offset each other at this point.
Gennady Goldberg with us around the table as well from TD Securities here in New York. Gennady, let's get into this data first, and good morning to you. What stands out for you? Does this push back those calls for an imminent rate cut?
Yeah, I think so. I think July is off the table. I think it's been off the table for at least the last few weeks. I mean, if you look at market pricing, we've basically had 1 or 2 basis points priced in for the last couple of weeks. I think it's really a function of September, November, December. That's the way I think about it. I like to think about it in ranges. So if you're thinking about, is it 1 or 2, 2 or 3 at this point? I think the data leading up to kind of this period in time has been calling for 1 or 2. Now it's a question of 2 or 3. So I think November potentially is in play, but we still think September is the first.
This is a very small difference in degree, but sort of walk us through it. What's changed that range for you from going 1 to 2 to 2 to 3?
Well, to the earlier point about, is the Fed really only focused on inflation, or are they actually starting to focus on the labor markets? There's been a very subtle messaging shift over the last couple of months about them actually starting to think about labor market weakening. It's no longer just about, inflation has to come down. Inflation has slowed, quite dramatically. Now it's a function of, well, if the labor market is slowing down as well, maybe we do have some weakness on both sides of the economy, and we actually have to be a little bit more careful about not over-tightening rather quickly. So I do think for them, it's a function of, look, we want to take rates lower. We want to start cutting rates gradually. But if the labor market starts to show signs of weakness, we have to go faster.
That said, it seems like there's this feeling that we're not getting a clear picture from some of the labor market data. We've seen this again and again. It gets revised significantly. It can look very different a month later when we take a look back. How much is your sense that the Fed and the markets are saying we're going to look past blips in the data that show solidness and look more at the weakness and count more on that and protect against that? How much do you think the Fed is on board with that? How low is the bar for them to point to the labor market as a reason to start making those adjustments?
I think it's much lower. I think we've certainly gone lower over the last couple of months. What really surprised me in the last labor market print wasn't the actual print itself. It was the revision to the last couple of months. The fact that the 3-month moving average went from 250K to 177 in a single month. That's not the kind of volatility you typically get from a 3-month or a 6-month moving average, for example. So we've been flying well above the break-even pace, which is around 175 to 200K, we think. Now we've gone well to the bottom of it. And now the question for the Fed is, well, if that persists, are we actually net, tightening more than we should be?
Well, everyone who's come on this show draws a distinction between weakening and actually a recession, and nobody has come on and said we're heading into a full-fledged recession, except for maybe Bill Dudley, who said that, maybe they're too late, but other than that, everybody else seems on board with the idea that there still is quite a bit of strength in the economy. So at what point are you looking at what's been priced into the bond market longer term in terms of rate cuts has already gotten it over its skis? That, yeah, they might start the adjustment, it might be 3 rate cuts now, but the whole idea is to prolong the business cycle so that they don't have to make bigger cuts later.
Yeah, I think, and that's why I think a 3rd cut is on the table this year. I mean, we officially have September and December cuts. The more labor market softening that we get, the more likely we are to get that November cut in play. And I know, everybody talks about the election as a potential kind of, stumbling block for the Fed. If they're cutting in September, they can certainly go in November, December, especially if they see labor market weakness. The big question for them and the bond market is 2025. Right, we've got the election coming up. We've got a lot of potential scenarios that could take us very astray from the soft landing scenario. We could have a big spike in inflation. What does the Fed do then? The bond market's having a lot of trouble pricing that one in. They're pricing in just over 4 cuts. And, the scenarios have gotten wider and wider and wider in the meantime.
How worrisome is it that the Fed may be cutting into an inflationary environment that Michelle was talking about? If we get high tariffs, that would, for the most people would agree, inflationary.
So I look at it as baseline versus the risk scenario, right? The baseline scenario, assuming there was no election, what would the Fed be doing otherwise? They would probably be cutting gradually, maybe a little bit faster if the labor market was slowing down into 2025. The question is, if we do get this inflationary spike, does that keep them on hold? Does that allow them to hike rates, as some have said in the market? We think it actually would allow the Fed to keep rates on hold, so higher for longer, but not quite at the highs. So if we get those couple of cuts this year, maybe to 4.75 or 5%, and we stay there for the first part of next year, and then the Fed reassesses, because we've got the inflationary spike coming through, then the growth shock actually impacting, and the Fed needs time to assess all that.
When we've been talking about the election a lot on this show, we talk about tariffs, the tax fight, but you're talking about even a bigger fight that potentially is going to happen at the start of the year, and that's the debt ceiling standoff. What's your base case for what the composition of the election could mean for that debate in Washington?
Right. I think the biggest risk scenario is mixed government. Split government, if you've got a Republican president...
But isn't split government good for the market?
Technically, yes. This is the one instance where I think this can actually create a big risk of a standoff. Remember, back in the 2011 standoff under Obama, that was split government as well. Nobody was really a fiscal hawk right up until the point where we got split government, and then all the fiscal hawks came out of the woodwork and then started to negotiate all of this. It is tricky from a timing standpoint, right? The debt ceiling gets reinstated January 1st. The X date, or the point where the Treasury runs out of cash, is only around, we think, July to September of next year. And it's troublesome because, Congress tends to be off in August. So either they deal with this before vacation or after, and it's going to get closed regardless.
So we've gone through a bunch of issues. What are the trades you're recommending?
I still think from a net standpoint, you want to be net long 10-year treasuries.
Okay.
We're still long 10-year treasuries. That trade's done quite well. We're still in 530s curve steepeners as well. That trade's done quite well. I think you want to hold on to these trades from a longer term standpoint. Where I think there's risk is in that curve trade, right? We're not necessarily going to a straight line, back to neutral for 10-year for Fed funds. If we stay at this higher for longer range, right? If we end up at 5% for the first half of next year, as the Fed reassesses the risk from tariffs, from immigration, all of that can actually lead rates a lot higher. That long may not work out that well, and you want to start to reassess that. So there's not, unlike this year where everyone was in steepeners, next year is going to have a lot more trades if you want to stay on the right side of the equation.
How many times has the word tactical come up over the last couple of weeks, right?
How can anyone be anything
Which is like code for I've got no idea what happens in the long term. Don't ask me.
And thank you. Thank you for the honesty. Because realistically, who could come on here other than Steve Eisman and say he knows with definitive certainty what's going to happen in November?
It's been like the theme of the program, flying blind into 25. Big time. Gennady, it's good to see you. Thank you, sir. Gennady Goldberg there of TD. Neil Dutta of Renmac Publishers writes in, the data today will reinforce the notion that the Fed has the benefit of time. In the Fed's mind, there is no need to rush, with private domestic demand growing at a solid pace over the second quarter. July remains a set-up meeting for September. The title, See You in September. Which is what we heard on the politics from Libby Cantrell as well over at PIMCO. So there you go.
This is basically the collective scream for please let us have a vacation.
Go on vacation. Go to the beach.
I will in a couple of weeks again.
Make it happen. Next week, right?
No, not next week. The week after.
The end of next week.
Yeah.
Good for you, Lisa.
Thank you.
All right, then me too. And then AMH. Everyone's got a holiday.
Maybe.
Don't worry. All right. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. I just want to recap some of that data we got. Initial jobless claims, those came in at 235,000 last week. That is just a touch below estimates. As for second quarter GDP, that rose at a 2.8% annualized pace, well above the estimate of 2%. The GDP numbers, as Neil was saying, does ease some of those concerns that the Fed would need to rush to cut rates to avoid a recession. Let's check in on shares of American Airlines, lower by 3.5% pre-market. It slashed its earnings outlook for the full year, becoming just the latest airline to temper expectations as fare discounts and high cost pressure earnings. It is the second time the airline has lowered expectations this year. Americans saying they, quote, did not perform to initial expectations due to their prior sales and distribution strategy and an imbalance of domestic supply and demand. And Kamala Harris is about to receive some big-name political support. NBC News is reporting that Barack Obama plans to endorse Harris soon. NBC says that Obama and Harris have been in close touch since she announced her presidential candidacy on Sunday. And that's your brief, John.
Hey, Danny, thanks for that. Appreciate it. And thanks for this morning. Up next on the program, we'll set you up for the day ahead. From New York City, you're watching Bloomberg Surveillance.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Counting it down to the opening bell, about 37 minutes away. Equity futures here just about unchanged. Things improving following that economic data, but the bond market's still bid and yields are still lower. We're down about 5 basis points on a 10-year, down 3 on 2s, just a break of 440 or so. And in foreign exchange, lots of attention. Lots of eyes on dollar yen. Dollar yen still lower on the session by 1/3 of 1%, but nowhere near where it was. Lower the session today was 151.94, and right now we trade at 153.38. So that data earlier, better GDP, stronger dollar, yields up just a little bit off session lows, jobless claims a bit lower than expected, just parking some of those calls, some of that urgency behind those calls for a rate cut as soon as this month. Let's get to the trading diary, what the rest of the week looks like. President Biden and Israeli Prime Minister Benjamin Netanyahu holding a bilateral meeting at 1 p.m. Vice President Kamala Harris also with a meeting of her own with Netanyahu at 4:30. We'll round out the week Friday with PCE and UMich and another Netanyahu meeting, this time with the former President Donald Trump at Mar-a-Lago. Then we're looking forward to all of that. Final thoughts, guys. I mean, where do we begin?
The difficulty understanding the technicals from the fundamentals. People are saying that just with such a huge bid up in certain stocks, that's what we're seeing, the unwind of those popular trades. Currently, on the flip side, the earnings have not been great, especially from consumer-facing companies. So right now, what my takeaway is that no one wants to go past the end of this year. Nobody wants to even wager what that might look like. So they're trying to understand short-term what it means if the Fed cuts rates, if data responds this way, to sort of game theory out one another, because trying to do the big picture, good luck.
And what policies happen next year for the Fed to cut or hike into? It's very confusing, staring into the sun. Lori Calvasino, that's what it feels like. I feel like last night with the president finally addressing the nation, we've put to bed, he was just going to serve out his term, and it is a brand new race. And now I think next week, it's all about where Kamala Harris goes, who her VP pick is, but actually the data becomes more important. This week felt like the politics was really important, and next week I feel like the data is more important.
Looking ahead to payrolls and a Federal Reserve decision as well, and all those tech earnings. Next week is absolutely stacked. Tomorrow's program is as well. Here's the lineup for you. First of all, David Malpass, the former World Bank president. We'll catch up with him about what's been developing in the bond market and issuance from the Treasury, and this recent paper from Nouri Arabini about whether there's been sort of this stealth QE coming out of the Treasury. We'll get his thoughts on all of that. We'll speak to Victoria Fernandez of Crossmark, Republican Senator Bill Hagerty. Look out for that. And I have no idea who booked this, but the AC Milan CEO, Giorgio Falani, joining the show as well, going into the weekend. Who booked that?
Yeah,
why are we doing that?
AC Milan's playing on Saturday.
I'm passionate about AC Milan.
Good. You better be tomorrow.
I know. You're going to be like, how much do you know? Let's go.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, GDP blowing away expectations. Futures rising 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a reality check on Wall Street. From autos to airlines, investors are digesting another string of disappointing earnings news.
And there is positive economic news after that. Better than estimated GDP data helping to ease fears that the Fed would need to rush rate cuts.
Plus, here comes this year's biggest IPO. We're going to be speaking to the co-founders of Lineage as the cold storage firm makes its trading debut. But let's get a check on where markets stand about 30 minutes until those bells ring. We have a little bit of a lift, at least some green on the screen after an absolute wipeout yesterday. You can see that the S&P 500 pretty much unchanged. NASDAQ 100, your big tech names, perking up a little bit right now, up about 0.1% in the pre-market. Meanwhile, the bond market, a rally underway. We are off the lows of the session when it comes to yields, but still the 10-year yield down about 4 basis points, Matt.
All right, as Cameron Kreis says, we took a collective trip to the pain cave yesterday. He's talking about commodities as well as long bonds, but stocks is where I noticed it. Take a look at the Mag 7. This is a grouping of the top 7 stocks on the S&P 500. They took their biggest hit yesterday on record, $760 billion of market cap erased.
There's a little bit more pain underneath the surface as well. A couple of stocks I'm watching. Shares of American Airlines are lower by 3.3% pre-market. Remember, it cut its earnings outlook for the full year. We'll talk more about that in the show. Ford also resuming its decline, about 13.3% lower after a second quarter profit print that fell short of Wall Street estimates, Matt.
All right, so a lot of disappointment yesterday, the biggest sell-off we've seen in stocks since 2022. And then this morning, we get this economic bombshell. GDP, we were looking for 2% flat, and it came out closer to 3 at 2.8.
And you can see the relief in futures right now with all the earnings doom and gloom that there is on the street and in the numbers. Even still, we have an economy that's holding up. The Fed doesn't have to rush to cut rates right now to save us from a recession. With GDP at what, 2.8%? That doesn't look very recessionary.
Yeah, and the risk off tone, at least this moment in the market, is pretty interesting. You think about the Wells Fargo note that came out just this morning, the call from Chris Harvey, the S&P probably sees another 2% downside before we can even discuss a bounce, he says. Let's see how many people agree.
Yeah, economic data in the last 30 minutes really changing things. As we said, let's get over to Mike McKee, Bloomberg's chief economics and policy correspondent. So, Mike, what do we know about the growth in this economy?
The economy is growing and faster than people thought, which has to make Fed Chairman Alfred E. Newman feel good. What? Me worry? He's got 2.8% growth in the second quarter. That's up from 1.4% in the first quarter this year. And not only was it a good number, it was good composition. Personal spending up 2.3%, business spending up 5.2%. We had build in inventories that offset a real drop in trade. So it's really a spending story at this point. And you look at what we got out of trade and inventories there, you can see the fact that they kind of offset each other. And we're going to focus on the spending part, which is what the Fed wants to see. Now, when you look deeper into that, you can also see durable goods orders were up. Well, headline was down 6.6, but capital goods orders, the important one, comes in up by a significant amount, 1% during the month, and that shows that companies are still spending money. And in GDP, much of that was on equipment. You wonder why the numbers may be bad for tech companies, because it's been good so far right now.
Mike, let's talk about jobless claims as well, because that also is coming in less than expected. Where's the weakness coming from, if at all?
Well, July is always difficult because a lot of companies shut down and retool, a lot of manufacturers, so it's hard to get an accurate read. But what this does tell us is that we're not seeing a collapse in any kind of in any way in the labor force, and probably the bulge that we've seen has been a little bit affected by external events like the hurricane down in Texas. Texas had the most initial jobless claims the last 2 weeks, and so that should start to fade, and we may even see it go down further. Bottom line is, at this point, the Fed doesn't have to move next week, despite Bill Dudley, and we may see some repricing, but September is the date to remember.
I was going to ask about Bill. You know, his op-ed yesterday said the facts have changed, so I changed my mind as well. Does he write part 2 to that op-ed today?
I don't think so. I mean, his overall point is that the economy is slowing and interest rates are too high for the longer term, medium to longer term. So I think what we're going to end up getting is the Fed cutting rates, but probably in September. Now, he urged them to do it next week. But if you take a look at the yield curve over the last couple days, and I haven't seen it in the last 5 minutes after we had these numbers come out, but basically the market's priced in a September cut, and they've also really pushed down rates across the curve, which suggests that even if the Fed doesn't move, they've got a cut already priced in there
The control room
that
is
they
on
can
fire.
sit back on.
Mike, I mentioned Dudley, they pull up the quote. You mentioned the yield curve, there it is for you. I mean, they're doing a stellar job back there.
It's amazing. We don't need to add more workers, I guess.
All right. Mike McKee, we do have to say goodbye. Really appreciate your reporting and your insight as always. But let's bring this conversation to the markets because we have a great guest on set with us. We're talking about Gabriela Santos. She is Chief Market Strategist for the Americas at JP Morgan Asset Management. Great to see you in person.
Great to see you.
So let's pick up on what we were just talking about with Mike McKee. You had Bill Dudley out yesterday saying that the Fed should cut next week. We had a Bloomberg opinion piece from Mohamed El-Arian today saying that the Fed may be 2 meetings away from a policy mistake. But then you take a look at the numbers that we got this morning. Is it really that urgent?
So I don't think it's urgent to reactively cut rates in a very aggressive fashion. But what investors want to see, what we want to see, are proactive rate cuts, which are gradual cuts just to keep the economy on track. And if you look beneath the surface at the GDP report this morning, if you take a look at the consumer, consumption grew 2.3%, better than the first quarter, which was only 1.5%. So that's good. But last year, consumption was growing 3%. So there's very clearly a downshift in economic momentum, and that's why it is important to normalize interest rates sooner rather than later. Now, sooner I don't think is next week, but September is still very much on the table, even after this morning's data.
What happens between now and September? If you think about the data and how backward-looking it still is, and the earnings we're seeing and how messy they are, do you see a lot more pain between now and September?
So I think for the markets, there are 2 separate issues going on. The first related to tech. Is an issue of expectations and also the delta of tech earnings, right? So expectations are high. You need to really blow it out of the water to see a positive stock price reaction. And the delta is slowing, right? For example, Magnificent 7 earnings grew 50% in the first quarter. They're set to grow 30%. Still amazing. The level is good. but the delta and the expectations are not moving in the right direction. Then when it comes to cyclical stocks, I think there's some growth concerns. The data this morning helps calm those down, but the delta is still downshifting. So I think that's what's causing a little bit of readjustment in the markets, but we think this is a normal correction. 10% once a year wouldn't be out of the ordinary. And in general, the levels are still good and still support a broadly rising market.
I've heard a lot of people refer to the Magnificent Seven as lifeboats, right? And yesterday, Shonali and I had lunch with a couple of investors who said everyone is hiding in those stocks. As we see a broadening out in terms of earnings, and I wonder if you expect that, does that mean those stocks continue to get sold off? Can people get off the lifeboats and get back on the cruise ship?
I think there's a lot of fatigue with the macro ping pong, right? Is it reaccelerating? Is it slowing? Where's inflation going? And so there's been some hiding out and some structural themes around AI, around healthcare innovation, around supply chain shifts, while we sort out the data. I do think if we get proactive rate cuts and there's a little bit more confidence in the continuation of the soft landing, plus a broadening out in earnings growth, which we're starting to see, then you can get a little bit, I wouldn't call it a rotation because we don't think tech sells off on a more sustained basis, but that you also get this nascent participation of other sectors. Now, I think it's not the kind of data that would merit, going from mega cap tech to small caps. There's an in-between there, which is other large cap sectors, maybe some mid caps for a little cyclicality. But overall, I do think the earnings season is going to help see some of that broadening out.
Well, we definitely need to talk about AI, but let's talk about that earnings broadening out that a lot of people have been waiting for and predicting that this will be the quarter that we see it. But so far, I mean, you take a look at autos, airlines, some of the consumer companies, Nestle, for example, in the last 24 hours, cutting its sales guidance. It seems like so far we aren't exactly seeing that.
It's been interesting. The first quarter earnings season was actually quite encouraging. If you just look at the headline, Mag 7 grew earnings 50%, the rest -2%. But if you actually look at the sectors, 8 out of the 11 sectors registered positive earnings growth. So that's encouraging that the earnings recession for a large part of the large cap market is behind us. And this quarter we expect positive 5% for the ex-Mag 7, and 8 out of the 11 still registering positive earnings growth. I think the trick is for those sectors that had been riding high on a lot of ability to raise prices, to consumer spending above average, those are actually facing a reality check. And that's where we come to travel and leisure, certain types of consumer discretionary. So it's really very, very nuanced depending on the type of company and the type of sector.
Yeah, I think even in automakers, it's very nuanced, right? Because Ford problems are Ford specific. Stellantis problems are Stellantis specific.
Tesla problems are very
Tesla specific. But GM, knocked the ball out of the park. So, and people are still buying automobiles. The question is which ones. All right, we're going to continue to talk about that for sure. And we're going to continue to talk with Gabriela Santos of JP Morgan Asset Management. She stays with us. Let's get a look at the stocks moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Matt, you were just mentioning Ford. Let's take a look at these shares. Absolutely plunging, down 14% into today. The stock up more than 10%. The stock now set to open down on the year with this big plunge, and it has everything to do with a massive 30% profit miss, adjusted earnings miss, despite the fact that they beat sales by 10%. Analysts saying this has to do with headwinds relative to warranties, plus the Ford Pro line not doing so well. Let's take a look at an even bigger plunger on the morning, laggard. This is Edwards Lifesciences, the heart valve company, down 24%. This after they missed the sales estimate. There's one particular valve that's at issue. Lots of price targets on the street taken down. It'll be interesting to see what this is from a superlative standpoint. What was the worst day before this? It looks like this could be the worst day in quite some time. And then finally, again, it's a bit of a brutal morning here for earnings movers. Take a look at Southwest Airlines and American Airlines, both to the downside. Southwest beat, but they offered a weaker outlook. They're changing their open seating order under activist pressures. Investors may be wondering what that will mean. American Airlines down 5.1%. They slashed their profit outlook and approaches with their sales outlook earlier this year, plus assessment of demand. Not doing so well right now. Katie will be taking a closer look at these on the open.
Absolutely. Abigail Doolittle, we'll see you in about 15 minutes' time. Now, coming up, more on how autos are doing next, with Ford on track for its biggest fall since October 2023. This is Bloomberg.
stories that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Let's take a look now at high interest, what's making headlines around the world. President Biden framed his historic decision to drop out of the 2024 race as a bid to unify the nation under a new generation of leaders. In an 11-minute speech last night in the Oval Office, the 81-year-old president said it was time to pass the torch to younger voices. Benjamin Netanyahu gave a fiery defense of Israel's war against Hamas in a speech to the U.S. Congress yesterday. The speech was boycotted, though, by dozens of Democratic lawmakers. The Israeli prime minister urged the U.S. to fast-track military aid, dismissed concerns about the war's mounting civilian death toll, and mocked thousands of demonstrators outside protesting his handling of the conflict in Gaza. Sustainable Metal Cloud and NVIDIA partner and a data center upstart from Singapore is raising about $950 million in fresh funds to try and tap the global artificial intelligence boom. Data center companies are targeting the Asia-Pacific region, which is expected to be the fastest growing market for the crucial AI infrastructure over the next 5 years. Shanali?
And Stellantis shares are plunging after net income fell 48% in the first half of the year. The automaker said it is now considering price cuts as it introduces new models. The company's CEO spoke with Bloomberg earlier this morning.
The automakers are under pressure. The auto industry is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil.
For more, we are joined by Bloomberg Global Autos editor Craig Trudell, and you think about what happened with Stellantis, with Ford. How much of this is specific to each of these companies, and is there anything that they said that can be drawn out into the broader world of autos?
Yeah, I think as you guys were talking about before the last break, I mean, I do think that there's absolutely some, company by company aspects here of whether you look at, Ford and their quality and warranty issues is very unique to them. I think with Stellantis, you have more of a product story of really a sort of mismanagement of some of their, most prized brands. I think Jeep has had real challenges. The Ram pickup brand also has been shrinking. Those two brands are sort of, where that company makes their money in North America.
Dodge,
and so,
dude. Don't forget, they canceled the Hemi. They don't make the Challenger. There's no Charger. I mean, what cars does Dodge even sell?
They wanted to, make an EV bet with Dodge, which was maybe a questionable decision given the sort of, customer base that is interested in Dodge vehicles. And I think over here in Europe, even in Renault, a company where, like Ford, they were making efforts to, split up the EV and battery business and sort of, reorient their company around, different powertrain types. I think in the case of both of those companies, you've had real execution issues to where, Renault actually, was going to try and list that business. It's, in retrospect, a good thing they didn't, given the sort of way that things have changed with EVs. I think, Tavares, talked about turmoil for this industry. There's been so many challenges and so many sort of unique challenges. A few years ago, everybody was struggling with supply chain issues. Now it's really more so a matter of getting this EV transition right, and it's proving really difficult for some of the players who are late to this. And I would put Stellantis in that camp.
Yeah, and you got to make sure you focus on quality control. Otherwise, you're going to be spending way too many billions on warranty issues. Craig, thanks very much. Bloomberg's global auto czar, Craig Trudell. Still with us is Gabriela Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. Let's talk just for a second. We showed some pictures of the Challenger, Dodge Challenger, gorgeous car, but they stopped making it in 2023 to focus on, more environmentally friendly products. When we see the election in November, is that going to change things drastically? I mean, are we going to go one way or the other in terms of, for example, the green energy push? I noticed after reading your notes that energy, like traditional fossil fuels, oil and gas, has done amazingly well under Biden and did horribly under Trump.
Yes. I think there are two things I'd mention here related to autos. The first is that there's just consumer fatigue in general. This cycle, we haven't seen more than 15 million annualized auto sales. Before, we had gotten used to 18 million. So there's just a broader fatigue around consumer durable purchases. But when it comes to the actual energy transition, this really relates to a question clients are asking us. Is there any policy signal in the midst of all this political noise? How should I be positioned? And one prime sector is energy, where there are clear policy differences in terms of traditional versus clean energy. That said, even if you get the outcome of the election right, the policy right, you still might not get the actual investment implication right. Under Trump, clean energy had a rally of 250%, where traditional energy fell 40%, and it's been the opposite under Biden. So it's much more about global prices, valuations. It's not really about the policy in and of itself.
By the way, those numbers bear repeating because
it's
I'll get flamed by J6 Twitter again. Yeah. But the fact is, energy stocks, oil stocks fell under Trump and gained under Biden, like bigly.
And that wasn't because of necessarily the policy in and of itself, right? But if we remember under President Trump, there were moments when oil prices fell quite precipitously. That was a challenge for the industry. In general, when you get more supply of oil, you would think oil prices fall. And if you have something global happening as well, that's not necessarily good if you're one of the oil majors. Versus you had a huge rally in clean energy, yes, partly related to policy, but also because there was just a push, more broadly speaking, for kind of tech innovative, unprofitable companies, of which clean energy was part of that trade, if we remember, 2021, 2022.
Well, you make a really good point that even if you knew the outcome, getting the trade right is a whole different story, and that's true for economic data, earnings, et cetera. But when you look to November, are there certain common denominators, common themes in either administration, no matter who actually wins the White House, that you can invest around?
Yes, there are quite a few, I think. The first one, most important one relating to the bond market, is higher deficits. And that's going to be, unfortunately, the theme for 2025. What's the outcome of the presidential election? What's the composition of Congress? What's going to happen with the 2017 Tax Cuts and Jobs Act, individual tax provisions that all expire at the end of next year? If you look at CBO estimates, the expectation is for the deficit to stay very elevated at 6%, but that assumes all the individual provisions expire. So really the debate here is what's the slope of that increase in the debt, and that will very much impact long end yields, which, as we've been seeing, there's a lessening of the inversion of the curve, and I think that's because long-term yields are going to stay anchored around some of these deficit issues irrespective. The last thing I'll say that's also really important is the rise of industrial policy, right? Both candidates talk about using government policy carrots and sticks to favor certain industries, and especially around this theme of reshoring production, self-sufficiency, friendshoring, and so a bigger read-through around, well, automation, can that help reduce costs, or can certain countries benefit? India, Mexico. So those are read-throughs irrespective of the outcome.
Unfortunately, we have to leave it there. Hope to have you back very soon. Our thanks, of course, to Gabriela Santos of JP Morgan Asset Management. Now, coming up, we'll take a look at the companies making the most buzz today in our Social Climber segment. Up next, this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, time now for Social Climbers, the companies making waves this morning. And first up, Universal Music Group shares sinking as subscription and streaming revenue growth disappoints investors. The world's biggest record label has faced headwinds with social media companies such as TikTok and Meta. Next up, Harley-Davidson beat second quarter revenue estimates thanks to higher shipments and better sales of pricier motorcycles in North America. Company also announcing plans to buy back $1 billion of shares through 2026. And finally, Chipotle looks to splurge on bigger portions to keep diners happy. The burrito chain's CFO says that these generous servings will contribute to some margin pressure in the coming quarters. And of course, you can follow all the company buzz on TREN Go on your Bloomberg terminal. Coming up, Michael Kantrowitz, Chief Investment Strategist at Piper Sandler. This is Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We had a down day on futures this morning. Then we had GDP data come out, a very positive surprise, and that kind of turned things around a little bit. So now you can see the S&P futures are unchanged. NASDAQ and Russell futures are rising as we hear the opening bells, which, by the way, are really interesting today because we have a couple of IPOs. On the New York Stock Exchange, Concentra starts trading today. They operate some company-sponsored healthcare plans. And then Lineage, the cold storage company that we're going to interview in just about an hour's time. So really interesting IPOs may be coming back into the fray. Let's get a check on the major averages with Katie Greifeld. Katie?
Well, like you said, Matt, a little bit of a turnaround going on this morning. You'd see the S&P 500, it's higher, just marginally, but still, that looks pretty good after what we saw yesterday in terms of the worst day in almost 2 years. Big tech up a little bit as well. The NASDAQ 100 up about 0.1% in the first moment of trading. And that rotation, maybe it's back, at least for this exact moment. The Russell 2000, those small caps, currently leading the way up about 0.3%. But one stock we're keeping an eye on is Hasbro, surging after the toy maker beat expectations for its second quarter results. In Chanel, you can see shares currently up about 6.6%.
A lot of divergence in this market, Katie. I'm also keeping an eye here on Ford, continuing its plunge after second quarter profit. That fell short of Wall Street estimates. You have Ford down in the middle of, or the moment the market opens, at almost 14%, more than 13% this morning.
All right, and American Airlines, those shares are lower after the airline slashed its earnings outlook for the year. We want to take a closer look at the airlines at large. For that, we go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, there's lots of pain here for airlines. The trend continues as demand for the current quarter, this all-important summer season, simply not materializing. Let's start off with Southwest. They're well off the lows. These shares down just 0.3%. Earlier, down about 3%. They beat, but they also cut the current quarter outlook, the third quarter outlook, because of this air pocket in demand. And they, in addition, in a real shift, they're offering assigned seating and premium offerings. You have to wonder what that's going to mean for those super loyal Southwest Airlines customers who like it the way that it is now. Time will tell, of course, on that. And then American Airlines down sharply. As you were mentioning, they slashed the profit outlook. The second time they've done this year, the stock down 4% into today, already down 26% year to date. The CEO admitting that they really got the demand picture wrong. Plus, one sales strategy around certain corporate customers not paying off. Again, these airlines down sharply, Katie.
Absolutely. An ugly day for those airlines. Abigail Doolittle, thank you so much. And let's keep the conversation going with Michael Kantrowitz. He is Chief Investment Strategist over at Piper Sandler. And Michael, there are so many cross currents right now between politics, of course, you have earnings underway, and then you have the Fed coming up next week. Take us through what your takeaway is right now. What is the ball that you're keeping your eyes on?
Well, I think, investors have continued to be very myopic. So I agree there's a lot of different variables impacting the macro and the market picture today. But what seems to always be mattering most is what investors are facing today. And so we're in the thick of earnings season right now. We're just starting, I think about a quarter almost of the S&P 500 has reported. So we're going to continue to focus on how guidance evolves during this earnings season. We've seen a lot of tail events so far. We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
One thing I'm wondering about, Michael, is how much more you're going to see volatility rise. You've seen the VIX rise to an 18 handle yesterday. It's holding the ground today. A lot of volatility under the surface, and the S&P 500 right now not figuring out exactly where to go. Is volatility in this market a good thing or a bad thing?
I guess that the answer is it depends. In some ways, it's a good thing for traders and for companies that provide trading. As a business, and certainly something that's been missing for much of this year. But it's an echoing of the current uncertainty and this backdrop on the macro front, on the policy front, both in DC and the Fed, and of course on the earnings front. So, we've had really low volatility for a while as inflation pressures have come off. Now we're starting to see unemployment rise. So I think the volatility backdrop is not going to spike anytime soon. But we're probably going to settle in at higher levels than what we've seen for much of this year.
I'm looking at shares of NVIDIA falling again today after breaking through a key level to the downside yesterday. And I'm just wondering if we're going to get an answer to whether or not AI pays off this quarter, or if it's going to continue to be a Google kind of wait and see message from all of the companies that report. So much has been invested. Michael, when are we going to see companies monetize it and that show up in earnings?
Well, I still think that's a longer story that goes well beyond. So I don't think we're going to get an answer definitively one way or another anytime soon. Therefore, I don't think that's going to be the ultimate make or break on the story for now. And obviously, we're just early on in the Mag 7 earnings cycle. We've got Microsoft coming up. And so I think we got to wait and see before we can make any longer term judgments on where we are in that cycle.
And Michael, I want to get to the business of forecasting because you made waves earlier this month with Piper Sandler dropping your S&P 500 target, calling that the practice is basically futile in this market. At the time, you said that having price targets on individual stocks makes sense, but makes less sense nowadays for the index. I'm curious, when you take a look at your sell-side community, would you expect that more firms will follow your lead here?
I don't think I'm the first to do that. I believe there's some other strategists over the years that have also avoided that practice. I think there's some firms that kind of have to do it because they have more of a retail exposure to their product. Our firm predominantly focuses on institutional investors, so active managers and stock pickers, where the market, especially given today's concentration, is really less relevant. And I think yesterday was another great example of this, where the average stock in the market was down about 1%, and the index, because of the heavyweight losses in Mag 7, which I think is almost down 17% or so from its peak, made the index go down a lot more. So I think ultimately it's what we can do to help our clients is focus on which parts of the market to be leaning into and avoiding, rather than trying to forecast an index where the constituents are at a 30-year low in correlations with that index today.
And it's a fair point. I mean, we also heard from Mike Wilson over at Morgan Stanley that he was backing away from big calls such as that one when it comes to forecasting just the index level. But if you are tying this to the concentration of the market, do you see an environment where you return to forecasting the S&P 500?
It's funny. I've been thinking about that and getting that question. And, maybe the right thing to do, again, for my client base is to focus on the equal weighted index, thinking of, again, from the opportunity set that institutional investors face. Perhaps that's given today's lopsided concentration makes more sense. But again, we focus on three things: direction, momentum, and endpoint. And ultimately, whether you're bullish or bearish can come across without necessarily having to have a specific price target. And we're still doing that.
Michael Kantrowitz of Piper Sandler, we thank you so very much. Of course, very complicated market we're taking a look at on the edge, really. But let's take a look at some M&A action because it is a day of mergers as well as IPOs. We're taking a look at Bally's here up on the day because we have Bally's, for example, up 23% significantly because they have agreed to a merger with Standard General, which is the largest
common. As a merger.
An acquisition.
There we go.
An acquisition.
Yeah.
Potatoes. But I agree. Then the other one that we're taking a look at, of course, is KKR agreeing to buy a software firm here Instructure for $23.60 a cash. And you have Instructure also up about 2% on the day on the heels of that deal. KKR down about 1%, but earnings ahead still for those big private asset managers. We'll keep an eye on it. All to say, guys, the deals are coming back.
Yeah, absolutely. Just check out MAGO on your Bloomberg terminal to see more on those. Coming up, airlines under pressure. More on the results from American as well as Southwest next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Quick check on stocks because we had futures down pretty big this morning, and they turned around after that GDP number came out. 2.8% GDP growth in the second quarter. That is pretty big. considering we're only expecting 2 flat. The S&P 500 unchanged, the NASDAQ unchanged, and the Russell 2000 gaining as investors buy those smaller cap stocks. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Citi downgrading Lululemon to neutral. The analyst says that after years of benefiting from outsized growth in the active apparel category, trends have actually slowed, and Citi's credit card data points to a further deceleration. Now, next up, Macquarie is downgrading Warner Brothers to neutral, citing the company losing its broadcast rights to the NBA. The analyst says that losing these key rights means that it now loses a core content assets for both its linear networks and its Max streaming service. And finally, you also have another call from Citi cutting Sirius XM to sell. The firm cites a valuation dislocation, with the stock up nearly 60% from its recent low. Now, Citi says that the recent appreciation in the company's equity may be the result of a short squeeze, Matt.
All right, excellent roundup there. Now, American Airlines shares are tanking, or they were taking a hit, I should say. They've now turned around, and it's pretty eye-opening to see them up 4+% because they slashed their earnings outlook this morning. Southwest as well, changing the way it's going to allot seats and actually reducing seat count as well. There are real problems in the airline industry, it seemed, with pricing power, and yet we see these two climbing on the day. Joining us to talk about why is George Ferguson. He is Senior Aerospace, Defense, and Airline Analyst for Bloomberg Intelligence. George, what is going on that, you know, in the space of an hour after a company slashes its full-year earnings outlook, the shares turn around and rock higher?
Also, thanks for having me on. So I think that part of the story here probably is the guidance for capacity in 3Q. And so, you know, what we saw is a lot of the U.S. airlines brought a lot of capacity to 2Q. American was in the upper single digits. You know, just levels of growth that the market just couldn't absorb. As we look at their numbers for 3Q, we're actually looking at its growth there. I think they're guiding sort of 2 to 4%. So that's something closer in line with GDP, especially, I guess, if the U.S. economy is growing faster in GDP. Southwest was also a growth number of 2%. They're expecting in 3Q. Those numbers are starting to get closer to where they ought to be growing. You know, I don't know that they're going to turn around the pain they saw in 2Q entirely in 3Q with some of this, you know, reduced capacity growth, but I think they'll start to ease some of that pain, and that's probably part of what's going on
We need to pull up a one-day chart. This is a year of American Airlines, which normally I prefer
There you go.
a longer-term look. But right now we need to show a one-day chart of what's going on with these shares, because you can see the movement, the volatility has just been pretty large. I mean, we were down at 920, and then we were up at 1080 all of a sudden. So I think the one-day chart, the GIP, which is graph intraday price, is probably the most interesting. That's a two-day chart, which is also pretty interesting. But again, I think the one-day chart is really where it's at today.
And George, you know, another thing beyond the stock price and beyond the numbers themselves, I'm really curious about what is changing with these carriers. You think about Southwest, for example, and them ditching the free-for-all seating, now doing assigned seating. What is all of this really about at the end of the day?
Yeah, so that's part of the, you know, what's going on in the U.S. airline now is that everybody wants to move into sort of premium product. And you might be surprised that premium product isn't a business class seat, right? It's where you sit in the cabin. And so the good carriers are really generating a lot of extra revenue by making you pay up for an aisle seat, make you pay up for a window seat, make you pay up for, you know, an exit row seat. And so Southwest is going to go the same direction. Southwest starting to look even more like the big three, United, American, and Delta. Look, I think this was probably a good change for them, as in they need to generate more revenue. This is a way to probably generate some of that revenue, separate themselves from the ultra low-cost carriers and the low-cost carriers, and not crush everything that they've sort of, you know, put out there as their product, which is, you know, things like bags fly free, free changes. I think this kind of works for them, you know, as a modification to boost revenue without hitting some more of the sacred items in their lineup.
And George, specific to American, where are they when it comes to business travel, for example? Because we know that the company has been working to rebuild its relationships with corporate customers, with CEOs. Where are they on that journey?
Well, I mean, apparently from today's numbers, not as far along as they should be, right? So they lagged their peers, Delta and United, in every region for yields, right? Yields are the price paid per mile flown. So it really looks like, you know, they've got a pretty decent deficit to Delta and United. Again, Delta United, I think, making better inroads for both premium passengers, premium leisure, and business, and I think that's what's supporting some of their revenue. So we don't get good numbers out of the carriers on how far back business travel is since the pandemic. I think United told us it's about 100% of what it was prior to the pandemic. So there's been no growth since 2020. So there's still a bit of a lag and a bit of a fight for that business travel. And yeah, America doesn't look like it's winning it right now.
George, we thank you so much for your time. That is George Ferguson of Bloomberg Intelligence. Now, coming up, we are getting ready for the biggest IPO of 2024. More on Lineage's listing next in today's Wall Street Beat. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Open Interest. You're taking a look at the stock market right now, and it's quiet, and that in and of itself is interesting after what we saw yesterday. Of course, the S&P 500 and the NASDAQ 100 falling mightily yesterday. Pretty quiet today. The S&P 500 unchanged. The NASDAQ 100, it had been higher. Now we're trending a bit lower now, down about 0.3%. But the small cap rotation continues. Small caps currently up about 0.9%, maybe helped by what we learned on GDP, really blowing past estimates this morning, Shonali.
And now it's time for the Wall Street Beat, because today we're looking at the year's biggest IPO so far. Logistics giant Lineage makes its public debut today. Joining us with more is Bloomberg's Bailey Lipschultz. And of course, the deal itself last night wasn't bad.
No, it was great.
$4.4 billion. Took a lot of banks to get it done. What is the tone like out there? Is this just a matter of such little supply in the equity capital markets?
Well, Lineage, Sonali, has been a name that has been floated
to go public for years. And I've talked to real estate investors who have said, we've met with Lineage over the last 3 years waiting for them to IPO, and now they're finally here. So raising $4.4 billion, they upsized that offering, so they sold far more shares than they initially had been targeting. So a bigger offering, but also priced within the range. So $78, that range was 70 to 82, so upper end, but they didn't push price, and that was the initial feedback I've gotten from talking to some of the buy-side folks.
I think Shonali mentioned this morning that it took 28 banks. Did you say 28?
I did.
28 banks to do this IPO. Why? And all the big names working on it together, right? I mean, nobody's at the top of the tombstone alone. Is that a new trend?
It's kind of where we're at. It seems like that's what we've been dealing with. So when you look back, this is the biggest IPO since ARM back in September. They had more than 20 banks or maybe 20 banks. We've seen a lot of banks on these deals just because there's not a lot going on. Sure, we're on pace to have year-over-year growth in terms of new offerings, both IPOs and follow-ons, but it still pales in comparison to where we were at even pre-pandemic, pre-2020, 2021 boom.
And we'll be speaking to, of course, the co-founders of Lineage coming up at 10:30 a.m. So maybe you could do some work for us. What should we ask them?
What are they going to do? Because the expectations are, you look at, there's so much uncertainty in real estate right now. And when I talk to folks on the buy side, acquisitions are ripe. So what is the company going to do? How are they going to put money to work? Because they did address some of their debt with this fundraising, but they're going to have some cash to put to work.
Initial stock sales doing just all right. People are still raising money, and now we're seeing that market broaden. What about secondary trading? You look at OneStream. Yesterday, very exciting private equity-backed company, made it to market. Super large pop on the first day, down the next day. What's sentiment like?
Well, that's really, you got to look at the trading. So when you look at this as a company, so OneStream had 11 million shares traded yesterday, so it traded about half the float. So we're still sub 400,000 shares in the first 25 minutes of trading, so giving back some of those gains. The thing, Sonali, that stood out to me was we had a massive sell-off yesterday in tech names, but yet OneStream held on to that 34% gain. We sometimes see this big pops, and then the big question is, does it regress? What does it mean that it regresses to, and what does the next week or 2 weeks look like? Giving back some of the gains, not a big surprise, but the big question is, a week from now, where are we at?
The story we love and that there's a big debate about on the street is Wiz, right? Google offered $23 billion just a couple of months after they had a $12 billion valuation, and they turned it down because they think they can do better with an IPO. The question is, when, you know, and will they have enough cash to invest in the meantime to show the growth that IPO investors demand?
Well, they already said in that letter, their CEO said, we want to get to $1 billion in ARR. So that expectation
and they're
is
at 350 now. And by the way, ARR is like annualized
revenue rate, I think.
Okay.
I'm not a CFA or anything special.
We just throw out acronyms.
Exactly. But the big thing is, when do they get to that? And is that something that has to hit before they go public? But when I talk to people, everyone's excited about 2025 class. Does Wiz sneak into the 25 class, or do they wait to 26? Remains to be seen, but they are growing really rapidly. And when I talk to folks on the buy side, they're super excited about the asset, and they really do think that that Google offer likely put a floor on what their valuation could be if they keep growing, and if they keep growing not only organically, but inorganically, because they do want to acquire assets.
30 seconds. One of the theories I've heard out there is that if you continue to see this broadening out, some love actually going to the mid caps, the small caps, it could encourage some companies to come out of the pipeline, actually go public. Does that hold any water with your sources?
Yeah, but the big thing is, Katie, does 1 week make a trend? Does a month and a half make a trend? When I talk to folks on the buy and sell side, they want to see this playing out through the entire quiet month of August, and then maybe we'll have a better conversation after Labor Day. But there's still so much uncertainty from a macro perspective, and also with the election, weird calendar to go public.
Like the election, you guys.
You should join us more often, Bailey.
This was fun.
Hey, man, I'm always in the office.
Come into the office.
I'm always here.
Bailey Lipschultz there covers stocks for us on the other side of the building. Coming up in about a half hour, we're going to be speaking to the co-founders of Lineage about their trading debut. It's a cold storage REIT that everybody's apparently psyched about. We're also going to talk to the CEO of NASDAQ, Adena Friedman.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
DOJ or other authorities
could face bigger challenges next.
That was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. It's Thursday. It's kind of, for some people in the studio, Thursday in the summer has become the new Friday. It's noticeable.
And by some people, we mean?
Me.
Yeah.
You guys have fun tomorrow. All right, we got a lot coming up here today. George Ferguson on the airlines. They're not making money. The stocks are down. I don't understand it. Maybe he can explain it to it. Gina Martin-Adams, she's going to give us what's going on these markets. Big sell-off yesterday, so she covers all the markets for Bloomberg Intelligence. And then the CFO of AstraZeneca, the company just recently reported numbers. We'll get some comments on that big pharma company that's coming up all in this hour. Let's kick everything off like we do. Mr. John Tucker.
All right, after the tech-led sell-off yesterday, NASDAQ 100 is down again. Down 0.9% right now. In the S&P 500, 7 of the 11 major industry groups higher, leading the way real estate. That's because yields are lower. Now, the worst performing group belonging to tech, information technology, and that is where you'll find NVIDIA down again today. Shares of NVIDIA are just about 4.1% lower right now. That GDP report earlier showing growth during the first half of the year, not too hot. Inflation continues to cool, and maybe that soft landing scenario does look within reach. Yesterday did see a $1 trillion rout in the NASDAQ 100, and Matt Maley at Miller Tabak says there's no reason to panic, but plenty of reason to be concerned.
You know, are these tech companies getting the return on investment, this massive investment they've made in AI? Are they getting it quick enough to justify the incredibly high levels, their expensive levels for most of these names that exist today?
And another big cue for investors may come with the next round of tech results. Apple, Microsoft, Amazon, Meta platforms all due to report results, of course, next week. Right now, the S&P 500, 21 points lower. That's down 0.4%, 5403. The NASDAQ 100, 1% lower, down 197 points. The Dow Jones Industrial Average, that's up 130 points. And that rotation is there. Russell 2000, the index of smaller cap stocks, right now is up 0.6%. 2-year yield, 3 basis points lower. We're at 439. The 10-year yield, 6 basis points lower. That is at 422. And this report being brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. The rates subject to change. Learn more at ibkr.com/compare. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul. Hi, Alex.
Hi, John Tucker. How are we? Friday Eve?
Oh, you know what? We're together tomorrow, the two of us.
Excellent.
As Paul is out. So
wow.
I have to substitute.
Yeah.
For you.
It's actually really fun. I mean, Paul's great too, but so is John Tucker. I'm Alex Steele with John Tucker. Paul Sweeney. This is Bloomberg Intelligence Radio. It is Friday Eve. It is the day after the global consensus unwind that we saw yesterday. My big question is, how much of all of this is selling to cover your yen short positions?
Really?
Yes.
I had not thought of that one.
I mean, we'll see. I think it's all connected, but still,
really? Okay.
Are we selling to cover those shorts? Anyway, there's also earnings, obviously, and some of those stocks are moving very hard, particularly to the downside if you miss, or even if you gain, to be honest. Norma Linda is here. She joins us from Bloomberg, equities reporter in the studio. All right, let's kick it off. I just want to start with Ford, because I don't know if I've seen this stock move this much in quite a long time.
Yes, this is a pretty substantial drop. We're seeing shares of Ford tumbling as much as 17%. Now, that's the most since we saw during that COVID lockdown week in March of 2020. And this is coming after its earnings missed pretty substantially. It reported adjusted earnings per share of 47 cents, which was well short of expectations for 67 cents. That was the estimate. But this is all due to what it blames on a surge in warranty repair costs for older vehicles. So we really have been seeing a lot of quality problems that have driven up Ford's warranty costs for years. But this was an $800 million spike in the second quarter that caught a lot of investors by surprise. But if you listen to the CFO, he said that, quote, "We can't read this quarter as the year coming off track. It's not."
Okay, but just for perspective, the stock has not fallen this much since May 12th, 2009.
Really?
Remember 2009?
I certainly do.
Oh, yeah. Me too.
Yes.
But then that's the thing. It's like the warranty thing just keeps getting, I think one analyst was saying, like, the warranty stuff just keeps getting worse. Like, we know it's there. That's not a surprise. But the amount and how much is the problem.
Exactly.
Is this because cars are just, people are holding on to cars longer and things?
I think there were just some defects that they're kind of dealing with.
I mean, it's the older cars that we're looking at here, so it would definitely make some sense.
All right, I also look at ServiceNow. What's going on there?
Yeah, so this is on the upward swing. It is seeing robust customer demand here. It reported subscription sales for the second quarter that account for the bulk of the company's revenue that jumped by 23%. That was to $2.5 billion. And shares are jumping for their highest level on record and most since 2022. So that's up to $828 per share. Nice. We've got shares up pretty substantially, as much as 13%.
$167 billion market cap company. I know nothing about this company.
It's
so... Totally. Some of these tech equities just gotten so big so quickly. Again, 52-week high today, or all-time high, I guess, right?
Definitely.
Very good. All right.
All right. New York Community Bank Corp. What's going on here?
It's a name we cannot get enough of over the past 2 years. But as we're looking at shares here, they're down as much as 17%. This is the biggest plunge we've seen since March. New York Community Bank Corp reported a provision for second quarter credit losses that was higher than the street's expectations. Its provision for credit losses was $390 million. The street was looking for $193 million. Oh, and also its subsidiary Flagstar Bank agreed to sell its mortgage servicing unit for $1.4 billion. So that's really what's been in focus this morning as we're looking at this stock.
And is this tied to the older issue, which is we've got some problems with our loans to these subsidized, and the housing, what's it in New
The
York?
mortgages?
Yeah.
No, are you talking
Mostly
about
apartments?
Yeah. Okay.
Yes.
So commercial real estate tied to that one building that had rent controlled issues.
This seems to be a bit of a separate issue, but a lot of people are still looking, and all eyes have been on this name regardless, especially as we think about that issue that we had about a year and a half ago.
All right, this is a part of the story that everybody knew was a risk, but the order of magnitude for these losses much bigger than the street was looking for. Okay.
Well, also just like a rolling thing too.
Yes.
It's like one building here, one building there. All right, Nora, thanks a lot. We really appreciate Nora Melinda joining us, a Bloomberg Equities reporter. Let's stay on earnings and things for a moment. Southwest Airlines up by over 3%. They are changing their open seat policy.
This is huge.
This is huge.
Yeah, I never really flew Southwest that much, and I don't know the reason behind the open seating, but I know that
Cheaper.
people like it. Cheaper.
Yeah, and also then you can pay for like where you stand online and stuff, right?
Yeah.
Wait,
All right, let's
you
go to
like the fact that you can get on an airplane, then you have to scramble to find a seat?
I don't.
I don't either.
But I mean,
a lot
but
of
if I'm
people do
super
like it.
budgeting, then yeah, maybe that would be something. But they are keeping their bags fly for free policy. But George Ferguson is Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us now. What did you make of them scrapping this open seating policy?
Yeah, it's all about revenue generation, right? So I think they're trying to put a little more distance on themselves and the low-cost and ultra-low-cost carriers, Frontier and Spirit. I agree with you. I don't know that all of us enjoy sort of scrambling for a seat when we jump on an airplane. So customers maybe, take this better than them scrapping bags fly free or no change fees. So to me, it seems like could be a good evolution in the strategy, makes them look more like their full service competitor, brethren, United, American, and Delta. And again, they need to generate some more revenue, so they're going to sell you aisle seats, window seats, exit row seats, premium seats. Yeah, they're starting to look like they're big airlines. They're starting to look more like the other big airlines.
And Alex, I note from the YouTube video that George is in our Queen Victoria Street offices, which are just spectacular, because he was at the Farnborough Air Show / Boondoggle in London this week. So good for George. Hey, George, every plane I get on, don't worry, I won't tell them because they're not in the office, your management team. The reason I go onto a plane, every seat is full. So that implies to me that demand is there. That implies to me that the airlines would have pricing power. But I keep reading that they're not getting good yields, and that the fact that the fares are coming down. Can you explain how this economics works?
Yeah, well, so I think this economics is the airlines put too much capacity in the marketplace. And this business is one where you don't let an airplane roll down the runway without it being 85% or more full nowadays. The revenue generation officers, they just keep selling tickets as long as it's covering the marginal cost, right? And so just because you saw all that volume didn't mean you were seeing all that, revenue as good as it should have been. Now, look, they're all at record levels of revenue, and that's because they got to find a way to pay for higher pilot wages. They're not anywhere near record levels of profit. So again, I think, they were kind of counting on an even stronger revenue environment, as they might say. We saw yields at American down 6%, which that's pretty. So, yields look like they're nosing over, and that's a lot about the concern here, right? We're seeing negative yields at all the airlines, and that's the concern that there's just too much supply. Consumers kind of is tighter and not willing to pay anything to go go on vacation, and that's the challenge here.
You got to hop in like 30 seconds, but American Airlines stock is now up over 2%. So what led that to the upside now?
Yeah, so some of the guidance I'm seeing is increases of 2-3% of capacity in 3Q. This could be the beginning of getting the capacity growth in the right area. I don't think it's going to be a great quarter, 3Q, but it could be better than we all expect.
All right. Thanks so much, George. Appreciate you. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us on Southwest as well as American. Joining us now is Gina Martin-Adams. Probably like no better guest to have after yesterday. Chief Equity Strategist at Bloomberg Intelligence joins us in studio here. Gina, good to see you.
Thank you.
I was saying earlier, did we just see all the selling yesterday as people were rushing to cover their yen shorts? Is that what I'm looking at?
Well, I think there's some of that. I also think that there was some somewhat disappointing tech earnings. You know, Tesla certainly didn't wow anybody. Even though Google or Alphabet numbers looked pretty good, there was not a huge momentum boost in terms of the outlook. I mean, I think that we just came into the season with such extreme expectations for tech. It's just really hard for these tech and tech adjacent companies to live up to those expectations, and we're seeing that play out in real time. At the same time, you're getting magnificent beats for the non-magnificent 7, right? So the 493 companies that we haven't talked about for the better part of a year and a half are actually starting to produce really strong earnings growth. That's pushing attention toward non-Mag 7 names for the first time in a long time. So capital's moving pretty quickly here.
Yeah, absolutely. I'm just, it's really is amazing, just kind of that sell-off we're seeing in technology. But again, you know, we've all knew it was coming at some point. I think most people have kind of flagged it as a risk here. You see a GDP print today. That's got to be good for corporate profits going. I know it's a look-back number, but boy, it seems.
Yeah,
pretty solid.
And I think that we've kind of underestimated the stability in the economy for the better part of the last 2 years, right? This has been the sort of drumbeat of negativity with respect to Fed policy change impacting GDP is really kind of getting tiresome at this point in time. We still have pretty steady GDP growth. We still have pretty steady consumer spending. We still have generally improving the manufacturing outlook. There's just not a lot wrong in the macro, but everyone's still so scared. So to the degree that we can get more beats and we can get more acceleration in the economic data, that could really power this trade even more, where the 493, you know, start to gather more market share, where the small cap index gets some more support. But right now it's just more of the same, very stable growth that still seems to be surprising a certain segment of the world.
Though, just to go back to earnings for a second, it's bringing me to Ford. That stock down, 17%. We haven't seen this drop since May of 2009, which none of us will care to remember. That says to me, is that like an earnings expectation game? Like that's what happens when you miss, when consensus has growth for. Let me just start this over. When earnings revisions have not come down into the quarter and then you miss, this is what happens. Is Ford an example of that, or is it something else?
Yeah, I think it's an extreme example of what can happen when you misguide consensus or when the analyst community is really off base on expectations. I don't think it's the representative of what's actually happening in the S&P 500 by any stretch of the imagination. I do
that's
think
an idiosyncratic situation.
Yeah, I think it is for the most part. I mean, to offset your comments about Ford, financial sector earnings are growing at 4 times the pace that analysts had anticipated. The banks all beat expectations. So, is Ford really that meaningful as a signal, or is this a company-specific issue related to demand for certain products and supply for certain products? I would say it's more company-specific than anything, but we're certainly going to keep watching the rest of the auto space and also all the interest rate-sensitive consumer names as potential, maybe there is more to this trade.
All right, Tom from the Upper East Side writes in with the VIX question. We're pushing up to 20 here. What does that tell you?
So VIX really is about how options traders are positioning. We like to actually look at the standard deviation of price changes in the index for a true volatility on S&P 500. I think that certainly there is a degree of, some panic maybe potentially emerging. Now, I wouldn't call it extreme panic. 20 is sort of long-term norms on VIX, but we do see at least some easing in what was very clearly mania by the end of June. When we were looking at things like correlations and standard deviations of price changes, we were just very clearly in a manic phase. Mania can create more mania, or it can ultimately create consolidations, and we're now in a consolidation phase. Is it a particularly onerous or meaningful consolidation? It's too early to probably say, but we are at least easing off of what was pretty manic conditions and maybe a little bit of too much exuberance in the market.
This trade today, again, just the NASDAQ down 1.3%, the Russell actually up. So that rotation that's been a couple weeks into play, 3 weeks into it, seems to be still there.
Yeah, and I think that this kind of goes back to our original discussion. We're now seeing growth elsewhere. We're now seeing more opportunities emerge outside of some very specific concentrated gains in tech stocks, which drove all of our optimism for the last year and a half. That may not be an easy rotation, but it is a rotation, and the rotation is still well intact.
Great stuff. Also, the Russell was only down 2% yesterday. That was just on par with the S&P versus like really getting hit harder, which is what we would have seen a few months ago.
Yeah.
Gina, we always appreciate you. Thank you. Wonderful to see you. Gina Martin-Adams, U.S. Chief Equity Strategist for Bloomberg Intelligence. Coming up, we're going to dig into earnings a little bit more here. Over at AstraZeneca, Arad Nasaran is Chief Financial Officer over at the company. We're going to break down some of those earnings. There's some questions about SG&A costs and R&D costs, but also pipeline when it comes to drugs. Sales did beat by 4% in the quarter, and they raised. We're going to talk about the complexities behind that beat within the market. All right, let's get you caught up here on where we're at. Tech still trading a little bit heavy, down by 1.2% again. S&P just down 0.4%, but the Dow Jones Industrial Average up 0.5%. Volume very heavy. Happy Thursday.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Day after their worst losses since 2022, more tech-led selling today. NVIDIA, among the worst performing stocks of the NASDAQ 100, as well as the S&P 500 right now. And that rotation, Paul, as you mentioned, is still there. The Russell 2000 index, the smaller caps, that is up just over 1%. As far as your earnings scorecard, 180 companies in the S&P 500 reporting earnings so far. 78% of those have delivered positive earnings surprises. And then you had the economic report earlier today, output topping Wall Street estimates, GDP 2.8% annual rate, and inflation also continuing to exhibit moderation. This all suggests demand is by and large holding up in the economy. Some of the individual shares on the move, they include Ford, 17% lower right now. Among the biggest laggards, adjusted earnings missing. They had a surge in warranty expenses. Bloomberg Intelligence says that likely is costing Ford more than $1 billion. S&P 500 down 20 points. That is down 0.4%. We're at 5406 on the index. The Dow Jones Industrial Average up 182 points. That's a rise of about 0.5%. And the NASDAQ 100, 193 points lower after yesterday's sell-off, down again another 1%. And yields right now, they are lower. The 10-year is down 6 basis points, 4.21. The 2-year yield, just about 4 basis points lower. That is at 4.39. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. Truly some of the smartest on the street. So let's get back to earnings here. AstraZeneca, that stock over in London, is now down by almost 2%. The company did report earnings that were pretty solid. The company came in with core earnings per share at 1.98 cents, $1.98, let's say it that way. Operating profit coming in about $4.10 billion. So we want to check in with the Chief Financial Officer, Aradhana Saran, over at AstraZeneca on this. It's great to get your perspective. We always appreciate the busy day that you have on earnings. Thank you very much for joining us. Give us some clarity on that top line growth and the upgrade that you had. You're raising that revenue. What is driving it in terms of product sales, and how much of that's collaboration income?
So actually, all the upgrade is being driven by product revenue. This year, we had, this quarter was actually a record quarter, $12.9 billion in revenue. And it was driven across the board with record revenues in all our therapeutic areas. So oncology, which is about 41% of our business, $5.3 billion in revenue, growing 19%. Cardiovascular medicines are growing 22%. Respiratory and immunology growing 26%, and our rare disease business, which is about a $2.1 billion business, growing 14%. And same geographically, you know, we're seeing very strong growth in the U.S., double-digit growth, also in emerging markets and in China, both growing around 18%, Europe 24%. So it's really demand for all our innovative medicines across different geographies and across different therapeutic areas. So we raised our guidance for the year, both on revenue and EPS, to now mid-teens. And it's almost, in some ways, you could consider a double raise, because we also said that we would meet these guidance without any increase in collaboration revenue that we were anticipating earlier in the year. So it's really driven by fundamental underlying growth.
So, Doctor, I know I'm just looking at the Bloomberg terminal here. I see you have a run rate revenue of about $50 billion right now, and you guys have said that you're targeting $80 billion in sales in 2030. What's going to bridge the gap? What's going to get you there? What should we be keeping an eye on?
So, you know, there's a lot going on in the pipeline. What's the ambition that we set for 2030 of $80 billion is driven by, I would say, 3 different elements. The first element is the products that we have today and the indications we have today and growth in those, and that's sort of what you see in the quarterly performance today. The second element is the current products that are on the market, but what we call life cycle extension. So entering into, for example, additional indications or expanding indications in other tumor types, et cetera. That's a second element. And then the third element is new molecular entities. So these are brand new molecules which we've discovered, we're working on, that are in phase 2 or phase 3 clinical studies, and hope that we'll be successful in them and we'll launch them by 2030. We have set an ambition of achieving this revenue, but also launching 20 new molecular entities by 2030, having 25 blockbusters, so that's products over $1 billion in revenues in the year by 2030. And what's going to bridge the gap? If you look at the studies we have ongoing, we will have probably about 40 studies in the next 18 months. So by end of 2025 that we hope to read out, and that will give us more confidence with the trajectory that we're on achieving that 2030 ambition. So, this is it's a risk business. Obviously, we take risk every day. We invest 22% of our R&D, of our revenue in R&D. So it's a very R&D heavy business. And, we hope that, our studies are successful to achieve those goals.
Are governments your friend or foe right now in terms of the UK being an unfavorable or favorable environment? There's also the threats of IRA potentially being rolled back under President Trump. How do you guys sort of think about government interaction with your company?
Governments are a very important stakeholder for us. In the U.S. As well as outside the U.S., many systems, healthcare systems, are single-payer systems. So we do work very closely with governments. The most important thing for us is to make sure that we have, once we've spent the money and developed innovative medicines, whether it's for cardiovascular disease or oncology, that patients actually get access to those medicines, and we can make an impact in their lives and, from diseases they're suffering from. And in that way, we need to be able to demonstrate that these drugs have value and are bringing value to the patients and to the healthcare system. And we work very closely with governments and with systems to make sure we get access to those medicines.
Dr. Sarin, I always joke on the show that when I come back in the next life, I want to be a healthcare M&A banker, because it seems every Monday we come in and there's another deal out there. How do you and your company think about M&A to kind of drive top line growth versus the R&D that you've already talked about?
So the ambition that we set for 2030, the 80 billion, does not include any major M&A. We are always looking from a scientific standpoint, not only within our own labs and identifying, what could be the next most promising molecule, but also looking outside and science that is happening in universities and biotech companies and so forth. Over the last year and a half, we've invested close to $7 billion in doing licensing transactions and partnerships and smaller M&A transactions that help to build our pipeline and really fit very well strategically with us in terms of the ambition that we have, and particularly in new therapy areas where we've made some investment, but it can help us leapfrog into the field, for example, in the case of cell therapies or in the case of radiopharmaceuticals, and accelerate the investments that we're already making. So, we're always looking for those types of partnerships.
So this is a really un-CFO-y question to ask you. What's the coolest drug that you guys are working on right now? The one thing that you're most excited about and a potential breakthrough there?
I don't know if it's an uncool or maybe it's unfair. It's hard to pick from your children, right? So there are just so many exciting things happening, and every few weeks we get some new data that makes us excited. So it's really hard to pick a favorite child. But there's a lot going on, and we live in very exciting times where not only is what we do in AstraZeneca is important, but science is evolving so quickly, and technology is evolving quickly, and we're sort of at the forefront of that innovation.
All right, thank you so much. We truly appreciate it. Aradhana Saran, Chief Financial Officer over at AstraZeneca, joining us on earnings. Really appreciate that. Now, I'm an only child, and I only have one daughter.
Okay.
But I'm always assuming that as a parent, you have a favorite. Or does
Well-
that not work like that?
Well,
you have multiple kids.
And my 4 kids, our youngest has always told us that he is the favorite, and this is when he was a little boy, because he gives the best presents and the best hugs. So I'll stick with. He's now 20 years old,
Oh,
but I'm going
okay.
to stick with that.
Okay. So maybe
I still get grief from the two saying, well, you have more pictures of him than me on the table.
So you may not actually pick a favorite, but they think you do.
Yeah.
So
I like the way you put that.
So drugs aren't sentient beings.
See,
so
I cut
they
them
can't
all off.
do that.
Once they graduate college, they're done. So
Yeah.
they're on their own. So that's equal opportunity.
Equal opportunity, tough love from Paul Sweeney.
Still waiting
All right,
for that.
coming up, we're going to talk about these interest rates here. It was very interesting yesterday. You definitely had a sell-off in the long end, and today we have consistent buying all across the board on the curve. We're going to talk to Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. In the meantime, we're going to go to Michael Barr for world and national news on this Thursday. Michael Barr.
Thank you very much, Alex. Paul, John, Democrats are lining up in support of the presidential candidacy of Kamala Harris, starting with those who have worked with her on Capitol Hill. Bloomberg's Irv Chapman reports from Washington.
Former Speaker Nancy Pelosi, who herself passed the torch of leadership to the next generation, led the women Democratic members of the House.
Kamala is about strength and determination. She is capable, officially, personally, and politically, to lead us to victory in November. We believe that when women succeed, America succeeds.
Pelosi and her colleagues made clear that the right to abortion would, along with economic issues, be front and center in the campaign. In Washington, Irv Chapman, Bloomberg Radio.
At his first campaign rally since President Biden's exit from the race, former President Trump turned his attention to Vice President Harris. Trump, speaking in Charlotte, North Carolina, says President Biden is unfit to lead, and so is Harris, especially at the southern border.
The borders are. When you look at how bad they are, you say, I like Trump, but now I really like Trump because we don't want to go back.
Trump called her his new victim to defeat and accused Harris of deceiving the public about President Joe Biden's ability to run for a second term. Harris, meanwhile, will speak today to the American Federation of Teachers in Houston. Israeli Prime Minister Benjamin Netanyahu is set to make a long-awaited White House visit to meet with President Biden and Harris today. It comes a day after his fiery defense of the war in Gaza in a speech to Congress. Tomorrow, Netanyahu meets with former President Trump at his Florida resort, Mar-a-Lago. Former Uvalde School District police officer who responded to the 2022 Robb Elementary School shooting that left 21 people dead, slated to be arraigned today. Adrian Gonzalez faces 29 felony counts. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start with the small cap stocks. That impressive run looks like it still has some steam left. It's the Russell 2000 that's leading the major averages today, up right now just about 0.9%. The tech-heavy NASDAQ, of course, suffered a $1 trillion tailspin in yesterday's trading, and it's down again today, right now down about 0.5%. It's paired some of the earlier losses in the session. For Anastasia and Moroso at iCapital, some company earnings results just have simply failed to deliver.
So you have lofty expectations, you have lofty valuations, and now you don't have the same surprise factor as you did before. So that's why I think investors will continue this unwind trade.
Well, Ford Motor suffering its worst drop in 4 years. A big earnings miss. The automaker blaming a surge in warranty repair costs. Demand is still there in the economy. Economic growth accelerating by more than forecast in the second quarter. The main growth engine, that would be personal spending, that advanced 2.3%, and also underlying inflation easing from the first quarter we saw in that GDP report that we got this morning. S&P 500 down now just 2 points, 54 at 24, so turning around there. Dow Jones Industrial Average, that is up 137 points, and the NASDAQ 187 points lower. That's down about 0.4% right now. And the yields, 2-year yield, 3 basis points lower. That's at 4.39. And the 10-year is just about 7 basis points lower. That's at 4.21. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. It's Bloomberg Business Flash. Paul and Alex.
Thanks so much, John Tucker. Some breaking news for you. This comes from Reuters. Meta is set to be hit with the first EU antitrust fine. Apparently, it's going to be hit in the next few weeks for tying classified advertisement service Marketplace with its Facebook social network. Again, this is according to Reuters. The EU Commission will likely issue its decision in September or October before the current EU antitrust chief, Margaret Vestager, leaves office in November. The stock is down by about 1.6%, but it was already down by about 1.6%. So there's that as well. All right, let's get to the bond market for a moment. It's been a really interesting couple days. So yesterday you had a lot of buying on the front end and you had some selling on the back end. Today, buying pretty much across the board. It's really that bull flattener that we're seeing. Joining us now is Ira Jersey. He's Chief U.S. Interest Rate Strategist over at Bloomberg Intelligence. First question goes back to yesterday. Was the long end selling a reaction to like needing to liquidate to cover shorts in the yen?
Well, I don't know if it was only the yen. It was also that a lot of people wanted to get into the front end because of the idea that we'd see deeper interest rate cuts, and because of that, you have to, if you're a real money investor, you have to raise that money from somewhere because you might not have all of that in cash, so you have to sell something to fund your purchases in the front end. I think part of it too was you had a decent 5-year auction. So you had some people who were saying, again, buying the belly and the front end and selling the back end. And then secondly, and this was really interesting, is that there were some people who maybe were hoping, and dealers who were hoping to get rid of some inventory into the Treasury buyback that occurred yesterday. And the Treasury didn't buy anything. They were, people were expecting them maybe to buy about $1 billion worth of 7 to 10 year notes, and they didn't buy any because I guess that sector was rich. So when you didn't have that, dealers have more inventory than they thought, and basically had to back up their prices, and that means higher yields.
Ira, we had that really strong GDP print this morning. Tom Keene was making the point earlier this morning that how can the Fed cut into something like that? The economy doesn't need it right now. What do you think?
Yeah, well, it's a momentum issue, right? Because keep in mind that the second quarter GDP report was for April, May, and June. So April and May we know were reasonably strong, and clearly June wasn't terrible by any stretch of the imagination. Economic momentum is slowing, so at some point the Federal Reserve might cut interest rates. But I agree with the idea that and we've always been skeptical about a September cut being the first one. And again, I don't really care. I think big picture, if it's September's the first cut or November's the first cut, it doesn't really matter, at least unless you're trading instruments that happen to mature in those months. So yeah, I think it is difficult, and it just shows, and what this report shows is that the economy, while it's not where it was a year ago, it's still not weak, and that's the challenge that the Fed has, is how can they cut while until the economy is actually weak, and you just don't see that very much. Even with 4.1% unemployment, that's not crazy high unemployment by any stretch of the imagination.
So based on that, what kind of curve do we expect? As in, is it going to be buying the front end, or is it going to be selling the long end?
Well, eventually it's going to be, I think, a bull steepener. So that means that front-end yields are going to go down much faster than longer-term yields. But it's that's going to come in fits and starts because of the same reason that we've seen it the last couple of quarters, quite frankly. And that's that we don't know when the Fed's going to start. And once the Fed starts, then the question is how fast do they go? And we've been of the opinion at BI Rates that the longer the Fed waits to cut, the deeper it's going to have to cut, and we do think that they're going to cut probably once this year, maybe twice. Once they do, they'll keep on going and keep cutting at least 150 or 200 basis points over the course of a year. And as that occurs, that's when you see the front end really start to gain some traction. But keep in mind, yesterday was interesting because the curve steepened 10 basis points. It only had steepened 18 basis points the whole year. Right, so you're talking about a massive move in terms of just relative to how much we'd moved this year in terms of the 2 versus 10-year curve.
All right, looking at that 2-year, we're at 440. We were at 5% just recently. Is that 60 basis point move? Is that a reasonable kind of move in that time frame, or is this a market that's been moving pretty quickly?
It's not that unusual. If you go back in time and you don't include the 2012 to 2018 period, it's usually the range of 10-year Treasury yields is somewhere around 100 basis points in a year. So seeing moves of 40 to 60 basis points over a 6-month period is not that unusual. In fact, we've had 3 of them just in the last 2 years. You go back to last October. We went from in August we were near 4%. In October we were near 5%, and then we've rallied all the way back down to under 4%. Right, so you're talking about 100 basis point range that we're in, and now we're headed toward the lower end of that. I think ultimately we will see by the end of the year a more substantial and obvious slowdown in the economy. So that's where you can see 10-year yields actually fall below 4% once again. But it's not. But it's going to be choppy. It's not going to be one-way street. It's not one trade that's going to bring us there.
All right, Ira. The men's Olympic soccer team lost 3-0. See what I did there? 3-0 to France. What do you make of that game, and what are your expectations for the U.S. team?
Well, I have to. So keep in mind, on the men's side, this is the Olympic team is the under 23s, and and a lot of our best players are actually under 23 and not at the Olympics because they play in the first team and they played in Copa America earlier this year. So it just shows you that the depth of talent in the U.S. versus some of the other big countries like France. France has very deep talent pool and they have a lot of under 23s who are outstanding players, and for us, we have some players that are outstanding at under 23, but there's a talent gap there from the top to the bottom in the U.S. Clearly in that age group.
And again, why do they play before the Olympic opening games? They're just too many? Is that the thing? And if you play earlier, do you not get to go to the Olympic opening ceremony or no?
In the world of soccer, Ira, the Olympics aren't nearly as big.
No, they used to be until the World Cup came around in 100 or so years, just about 100 years ago. But one of the reasons that the Olympics soccer starts early is because you can really only have 2 games a week. And the Olympics itself is only 2 weeks. So unless you had 8 teams only going to the Olympics, it'd be hard to finish the tournament before that. So that's why you have. If you have 16 teams like they do, I think it's 16 if memory serves, you basically have to start a week before or a couple of days before the actual opening ceremony.
Adding more and more value every day. Ira Jersey with the Soccer Talk. He's also has a side gig, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Looking at the 10-year Treasury, we're in 6 basis points. 4.21%, and the 2-year 4.39%. So some movement in the bond market. We'll have more coming up. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with your company news. Just preparing it right now, in fact. So who's going to miss the bad scramble? Southwest Airlines will begin offering assigned seats, ditching that free-for-all policy that's been a defining feature of the carrier for more than half a century. I didn't know they were in business half a century. Airline announcing the seismic change to its business model today, alongside the new premium class option and plans for red-eye flights as well. In that earnings report they had, they pointed to the seating changes as piece of an ongoing comprehensive upgrade to passenger accommodations. And as you pointed out earlier, Alex, they're not going to charge for checked bags, at least not yet. By most accounts, Amazon.com pulled off another successful Prime Day summer sale, enticing millions of shoppers to spend billions online at a time when people might otherwise be distracted with their summer vacations. There was one red flag for the world's biggest online retailer. Millennials, they were the only demographic group whose Prime Day spending actually dropped this year compared with a year earlier. The drop was about 1.3%, but it's an outlier compared with the baby boomers, Generation X and Gen Z. And Oleksiy Babenko, founder and chief executive officer of V-Read Drone, he's understandably publicity shy. That's because his business is a target for Russian military. He churns out more than 6,000 exploding drones a month In his office somewhere in Kyiv, the 25-year-old, an unlikely figure to be a defense contractor. Before the war, he roamed around Europe as a street performer. He makes what are known as first-person view drones. An FPV drone looks a lot like the ones you find in the Walmart toy section, except they strap bombs to these. That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We also keep you up to date on world and national news, and for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, John. President Joe Biden framed his decision to drop out of the 2024 race as a bid to unify the nation under a new generation of leaders. It was Biden's first speech since ending his re-election campaign and political career.
It's been the honor of my life to serve as your president. But in the defense of democracy, which is at stake, I think it's more important than any title.
We got reaction from Tina Fordham, founder and geopolitical strategist at Fordham Global Insight.
It's the end of an era. Joe Biden has served the country for many decades, and he's passed the torch. Some would say he took his time about it, but I think we have seen very clearly in the momentum behind Kamala Harris that there's a huge appetite for energy and for new voices in this race.
Tina Fordham, founder of Fordham Global Insight. At his first campaign rally since President Biden's exit from the race, former President Trump turned his attention to Vice President Harris. Trump, speaking in Charlotte, North Carolina, says Biden is unfit to lead, and so is Harris.
She'll destroy our country if she's elected, so we won't let her be elected. We can't let that happen.
Trump called her his new victim to defeat. Harris, meanwhile, will speak today to the American Federation of Teachers in Houston. New York Governor Kathy Hochul was sued over her pause on the city's traffic congestion pricing plan by an advocacy group that claims she had no legal authority to put the program on hold. In its lawsuit filed today in New York State Court, the City Club of New York asked the court to force the New York Department of Transportation to implement the plan. According to the suit, Hochul's pause is unlawful and blocked the state from any further actions to halt the project. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Alex, Paul, John.
All right, thanks so much, Michael Barr. So let's just stay on the Olympic track that we were talking about last with Ira Jersey. There's a great piece in Bloomberg right now that talks about how Olympic athletes are going high-tech to beat extreme heat, meaning that they're using wearable heat sensors to inflatable ice pools. They're adjusting how they train and their performance routines based for extreme heat, because apparently, check this one out, Paris has warmed 1.8 degrees Celsius since it last hosted the Olympics in 1924. I don't know what that means, but that feels like it warmed. This is according to a recent report. And a 2,100% increase in tropical nights.
Yes. So the same stone buildings, zinc rooftops, and narrow streets that make Paris so charming can also make it swelter. So, I mean, if you're an athlete, particularly these extreme athletes at this level of the Olympics, and you're training all the time, and you have to deal with it, I guess. And so there's just, you know, lots of different ways and lots of different athletes in different sports are dealing with it. On the flip side, like on the snow sports, there's a lot of cities that I think historically have hosted the Olympics that won't be able to do it again because they don't have reliable snow.
Oh, interesting.
So it's both sides of the equation. So when I see data like this, like that, you know, 1.8 degrees centigrade, you see that kind of data all Celsius, okay. Thank you. You see that kind of data about warming all over the place. I'm not sure what climate change deniers hang their hat on. Isn't the data clear?
Yeah, I mean, you're definitely talking to the wrong person.
I don't know. That's just an honest question. It just seems like everywhere we go, we see this data that it seems pretty clear. I guess maybe you could argue the cause and effect.
I was wondering. I wonder if it's more like who's to blame for that is where it gets pretty dicey.
And the data show we just came off the warmest year ever.
Yeah.
Yeah. Just ask my Con Ed bill for May, and that was May. No, June. June.
Do you have a zinc roof?
No, I don't think so. I mean, but
you
apparently,
should know this.
I guess. I mean, I live in a condo, so I don't think we know those things. But yeah, that kind of bill wasn't great. But that was really interesting. It's a really cool article. You guys should check it out. There's some really good pictures too, of sort of what these athletes are doing and how they're training, like cycling with all these layers on inside. Anyway, it was really interesting. All right, much more coming up in the next hour of Bloomberg Intelligence. We'll be talking with Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks, on what's happening with New York Community Bank. It is back in the headlines. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Coming up in this hour, we got a lot of stuff happening here. Let's start off with luxury. That's for John Tucker. I mean, LVMH carrying some tough numbers. What's going on in the world of luxury? Deb Aitken, she covers all that stuff for Bloomberg Intelligence. She'll join us. Sean here, principal and managing partner at Trinity Investments, on the state of commercial real estate. This is a topic that we love. And then we're going to check in with the boss, Karen Ubelhart. She's Bloomberg Intelligence Senior Industrials Analyst. She covers all that industrial stuff, Deere, Caterpillar. Today we're going to talk about Honeywell. They had some numbers out recently. So a lot coming up in this hour. Kick it off with one, John Tucker for Bloomberg Basic Splash.
Because when you think luxury, you think me.
John Tucker.
The tech-heavy NASDAQ now shedding some of the earlier losses. In fact, we have turned around after that sell-off of over 3% Wednesday's session. That was just about the worst day in about 2 years. The tech-heavy NASDAQ Composite Index has turned higher. It's up 0.1%, up 18 points right now, 17,356. NASDAQ 100 still just about 6 points lower right now. The GDP report showing economic output topped Wall Street estimates, running about 2.8%. That's an annual rate. Inflation in this report also continued to exhibit moderation. Meantime, Margie Patel at Allspring Global Investments believes that stocks are going to rebound.
The economy clearly is in a slowing mode. Globally, it's slowing. I think right now we're in a mild correction, not some kind of a permanent crash to down 20% and staying there. So I think it's just a choppy period, market recognizing slower growth.
And right now, within the S&P 500, 12 points higher. That's up 0.2%. Dow Jones Industrial Average, 209 points higher. That's up 0.5%. The NASDAQ is right now, it is NASDAQ Composite Index. I'm going to call it unchanged, kind of bouncing between gains and losses. 2-year yield is 2 basis points lower, 440. The 10-year, 5 basis points lower. That's at 422. Among some of the movers, American Airlines cutting its earnings outlook. They're trying to bounce back from some of their earlier mistakes. And right now, those shares, American Airlines, they are up 6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash.
All right.
I was going to show you some of my luxury items that I carry with me.
Which would be?
Gucci handbag.
Is it your badge?
No, I was going to...
He's digging deep right now.
My wallet is Carhartt. That's the they make tools and stuff like that.
Of course.
They make
This
clothing
makes sense.
for, carpenters.
So we were debating. So John Tucker does have high-end tools. So we were trying to figure out if he has more tools than my mother has luxury designer shoes. We're not sure. We don't know if his table saw counts for like 10 shoes or
I admit defeat on that front.
It's a dicey thing. Well, so much for that tech correction. I mean, that was a short-lived moment. Jeez. Okay. Norma Linda is joining us, Bloomberg Equities reporter. Definitely not as much follow-through selling today. It's super interesting, particularly if you look at this chart of tech. It's like a nice V in early morning trading. And even the good stocks are getting better, like American Airlines up now 6%.
Yes, and when you look at the broader market, it's interesting because yesterday we saw 336 stocks in the red, but if you're looking at the S&P 500 right now, we've got about 386 up. And one of those is American Airlines, despite that profit outlook slash that it did have coming out of those earnings. It cut its earnings outlook, hoping to bounce back from earlier woes that it had that were weighing on revenue profits for the rest of 2024. It said that its full year profit will be 70 cents a share to $1.30. cents. This is lower than an earlier outlook that it did have, which was as much as $3.25 per share. But it doesn't seem to be hindering the stock too much. I mean, we are seeing a bounce back here with shares of American up 6.7%, and that is the most since April of this year.
Yeah. That's interesting. You know what stock, though, hasn't rebounded like American Airlines is Ford. So, okay, it's not
this is big
down.
today.
I mean, it's huge. I mean, this is the most this stock has dropped since May of 2009. It's still down by 17%.
It is insane today as we are seeing a really deep sell-off here for Ford. It's really blaming its big earnings miss on the fact that it's had a surge in warranty repair costs for older vehicles. Apparently, they've been having a lot of quality problem concerns, particularly in a lot of its more older vehicles, and that has put $800 million spike in the second quarter. This really caught investors off guard, but the CFO did say that this is a, quote, one-time jump in quality-related issues, but we'll have to see.
I mean, that was my read when I first saw this, a one-time thing. I hadn't heard anything like there's a real quality problem at Ford. So if this is a one-time thing, why am I knocking 17% off the market cap here? So, I mean, if that's in fact the case, I don't know.
But then I will say last year, Ford spent $4.8 billion fixing customers' cars, and that is roughly 3 times higher than industry standard.
Oh, well, there you go. All right. I guess that's an issue.
Yeah, maybe a
That's
slight
an
issue. Hey, Abigail, we appreciate you. Thank you very much. No, you're not Abigail. Nor. I was just reading.
A friend of Abigail's.
No, I was just reading an email from Abigail about New York Community Bank, which is our next topic, henceforth.
So she was multitasking.
I love it. Thing to do. Nor, I know who you are, Norma Linda. Thank you very much, Bloomberg Equities reporter, because I was going to say another stock is down about 6% is New York Community Bank, and I say that because Herman Chan is in the studio, and clearly we only talk to Herman Chan when regional banks are in trouble. So henceforth, he is here. He's Bloomberg Intelligence, a senior analyst for U.S. regional banks. So this is, at one point, this was the worst day for the stock since March.
Right.
They reported a bigger loss. Loan loss provisions were bigger than expected.
Right.
Multifamily and office is still a problem. Okay, that doesn't sound good.
Yeah, so it's a long road continuing for New York Community to reach a path back to profitability. Consensus was expecting a bit of a narrow loss, but management has said that they scrubbed the credit portfolio and saw higher losses, including higher non-accrual loans. That's a problem. Their guidance for their medium-term outlook is weaker, and it's going to push out profitability to peer medians back to maybe mid-year 2027. So it's a long road ahead.
So is this a NYCB specific problem, or can we extrapolate to other banks here?
At this point, this is very much so a New York community specific problem. The rest of the regional banking space has done really well in terms of producing stable credit quality, improving margins in the second quarter for the first time in a year, and the top line trajectory is actually improving as well. So everything's moving in the right direction for the group. It's just New York community is lagging because of their idiosyncratic issues with office and apartment lending in New York City.
Apparently, it was also Flagstar Bank as a subsidiary and agreed to sell its mortgage servicing business. Can you just talk us through what that means?
Yeah, so a priority for the bank is increasing capital and liquidity with the uncertain backdrop that the bank is facing. And one way of doing that is selling good assets, but on the flip side of that, it's reducing their earnings power. So that's why profitability is pushed out to 2027.
So commercial real estate, regional banks, people that come into here that are real estate investors are saying, it's just a regional bank problem. There's no big shoes to drop and don't worry about it. We're, blah, 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 blah. What are the regional banks that you cover telling you about exposure to commercial real estate, particularly office?
Yeah, they're saying that they're seeing continued deterioration, but that's expected. We should step back and say that interest rates have been rising for over a year, and they've pretty much plateaued and expected to come down potentially in September with the rate cuts. This is a very well-known situation where banks have been preparing for losses quarter after quarter, adding to their reserves, and the underwriting has been pretty conservative. So we're not seeing a lot of loss content, and the stuff that is creating losses has been reserved. So it's not going to be a disastrous thing for the banks that I cover.
All right, Herman, thanks so much. We appreciate the hustle. Herman Chan joining us, Bloomberg Intelligence senior analyst for U.S. regional banks. And here we go. One of my favorite stories of the last 48 hours is what's happening in luxury retail. Hermes is going to be reporting after the closing bell in Europe, so it's after 11:30 Eastern Hour Time. We had the likes of all the other guys. Who are the other guys now? Richemont not doing really well.
Yeah.
Gucci sales disappointed, and that wound up hurting Kering, their parent company.
Yep.
LVMH also struggling. I mean, it's grim out there. Deborah Aiken is Bloomberg Intelligence luxury goods analyst, and she joins us on this topic. Deborah, how much of the weakness is a China problem versus a broader problem?
Hi. Yes, some of the weakness is a China problem, but I would say it's around 10% of the problem at the moment, because we're already against a difficult base last year where we saw the market only open in January last year, doing well until it took a while for stores to build again in China. And then we saw a drop-off May, June. It picked up a little bit more by September through December. It contracted again. And I would say that into Q2, we're actually probably flat in China year on year. But what we have is actually some of the Chinese cohort, some travel to Europe, but especially and particularly travel to Japan. And that is skewing numbers.
Right.
And there's more into that we can talk about.
So, I mean, I guess the question is, what are these luxury brands? I mean, they've had a good run. Is this just kind of getting back to maybe a more normalized spending pattern by typical luxury consumers, or is there something else going on here? Because I can get a Gucci Jackie 1961 medium shoulder bag for $3,900.
Would you want to?
What?
How about
Wait,
that?
what just happened here? Did you look up luxury retail on your
I'm looking
computer?
at the Gucci site here.
my gosh,
the
that brain
Gucci Jackie 1961 medium shoulder bag. Tom Keene was looking at this morning. $3,900. So
There
what
we
happens
go.
here?
Right, so probably two stories here. So let's touch on Gucci afterwards, but let me just run through